Hello everyone. Now in the booster series of lectures, let us start with the fourth chapter, Income from Salaries. What are the sections that are covered under the head Salaries? Section 15 to 17. Basically three sections. What is the charging section? Charging section is section 15. Method of accounting followed under this head is due or receipt basis, whichever is earlier. In our previous lecture in residential status, we have discussed the difference between accrual and due. Accrue means what? Right to receive. Due means what? Right to enforce the payment. Let's say employer and employee, they entered into agreement. Salary of employee will paid by employer on 7th of next month. This is the agreement. That means what? In the month of August, employee rendered his services. When his salary gets due, his salary gets due on 7th September. Salary is accrued in the month of August, but salary will get due in the month of September, 7th September. Are you able to understand? So, let's say an employee joined in the month of April and employer will pay salary to him on 7th of next month. Now, how many months salary will get taxed to him? April month salary will get due on 7th May. May month salary gets due on 7th June. Likewise, every month salary will get due on 7th of the next month. So considering this, like April month salary is getting due in the month of May month salary is getting due in the month of June. So overall 11 months salary is only taxable in current previous year. From next previous year onwards, 12 months salary is taxable. Are you able to understand? So due means what? Due date. On the due date, it gets taxed. Even though on the due date salary is not paid, still salary will get taxed because the method of accounting followed is due or receipt basis, whichever is earlier. Advance salary was received. Advance salary is taxable whenever it is received. Let's say this is the month of February. I am in need of money. I went to my employer and I asked him to pay March month salary also in the month of February. Employer paid February salary and March salary in the middle of February. Now, whatever the advance salary that I have received, it is taxable to me. Another example. Now, I am in urgent need of money. I want 4 months salary. March, April, May, June. April, May, June are falling in next financial year. Even though they are falling in next financial year, if those months salary is received in current previous year, it gets taxed in current previous year because like it will get due in the next year, but it is received in advance. Advance salary is taxable on receipt basis. Are you able to understand? So the method of accounting followed under the head salaries is due or receipt basis, whichever is earlier. Next, provision. What provision says? Let's say there is employer, there is also employee. Whatever the benefits received by employee from employer are there, these benefits can be either monetary benefits or non-monetary benefits. All these benefits are taxable to the employee under the head salaries. So many people think that only monetary benefits are taxable. No, not only monetary benefits, even if any non-monetary benefits are received by employee, those non-monetary benefits are also taxable to the employee under the head salaries. Now, employer can be either past employer or present employer or future employer. See, pension is taxable under the head salaries. After retirement, pension is received. Pension is received from past employer. Even though benefit is received from past employer, that is taxable under the head salaries. Next, anyhow, benefit received from present employer is taxable under the head salaries. Future employer, many of the CAs are getting qualified, they are going to campus and they are getting jobs. Now, after they get selected in campus, they will get 1 month time. Okay, company will do background verification, then company will give joining letter. So meanwhile, in these 15 days to 1 month, employee may go and join in another company. That's why once you are selected by a company, they will give you salary in advance even before you join the company, just to retain you. In such a case, whatever the advance salary that you have received from future employer, you did not join the company, but you have received advance salary from the employer whom you are going to join, okay, future employer, even that benefit is also taxable under the head salaries. And some of the students asks me, sir, only full-time employment? No, even by doing part-time employment, if any benefit is received, that benefit is taxable under the head salaries. Not only full-time employment, from part-time also. Next, main important point, precondition. Only if this condition exists, then only benefit is taxable under the head salary. What is that condition? Like, in between employer and employee, there should be principal and servant relation. Only if the relation between payer and payee, here we can call employer as payer and employee as payee. The relationship between employer and employee should be principal and servant relation. Then only the benefit received is taxable under the head salaries. See, there are two types of relations: principal to servant relation, principal to principal relation. In case of principal to principal relation, like, one party tells to another party what is the work that is to be done, how that work is required to be performed. It is entirely at the discretion of the opposite person. That kind of relation we call as principal to principal relation. Best example, the relation between doctor and patient. Okay, patient will come to the doctor and he will tell his problem to the doctor. How to treat that problem, how to cure that disease, treat that disease, that is entirely at the decision of the doctor. This type of relation we call as principal to principal relation. Okay, chartered accountant and client are there. Client will come to the chartered accountant and ask him to do the audit. How audit is to be performed, that is entirely at the decision of the chartered accountant. Lawyer and client are there. Now client will tell what is his problem and what exactly the facts are. Now lawyer will decide how to how to speak in the court of law. That means what, in all these relations, one person is telling another person what is the real problem and how to treat that problem is entirely at the decision of the opposite person. This type of relation we call as principal to principal relation. Out of principal to principal relation, if we get any benefit, if we receive any income, that income is taxable under the head PGBP. But out of principal to servant relation, in case of principal to servant relation, principal will tell servant what is the work that is to be done, how that work is required to be performed, how that work should be performed. That will also be told by the principal. If that work is not done properly, action can also be taken by principal. This type of relation we call as principal to servant relation. Employer will tell employee what is his scope of work and how that work is required to be performed. If work is not done properly, employer can take action. This type of relation we call as principal to servant relation. Out of principal to servant relation, if any benefit is received, that benefit is taxable under the head income from salaries. Are you able to understand? Good. So I have explained the precondition and general provision. See, in all these cases, whatever the benefit that is received, that is not taxable under the head salaries, but that is taxable under other heads. The only reason is there is no relationship of principal and servant. Only if there is relationship of principal and servant between payer and payee, then only benefit is taxable under the head salaries. Commission received by insurance agents. See, insurance agents, if they get commission from insurance companies, insurance agents, right? How many policies they do, that much of commission they will receive. That means what? Here the relation is a bit of principal to principal relation. So whatever the commission received by insurance agent is there, that is not taxable under salaries because there is no principal and servant relationship. That is taxable either under PGBP or under IFOS. Remuneration received by partner from partnership firm. See, uh, the relationship between a partner and partnership firm is not principal and servant relationship. That's why even though partner gets remuneration from partnership firm, such remuneration is not taxable to the partner under the head salaries. It is taxable under the head PGBP. Next, pension received by family members of deceased employee. Listen one thing. I worked in an organization. After I came out of that organization, I am receiving pension. That pension is taxable to me under the head salaries because I am receiving benefit from past employer. After my death, my family members are receiving pension. Now, in between that employer and me, there is employer employer relationship, company and me. But in between company and my family members, there is no employer employer relationship, right? That's why if my family members receive any pension from the company, for them the whatever the pension that is received, that is taxable under other sources, as there is no employer employer relationship between company and family members of the deceased employee. Next, directors sitting fees. If any fees is received by director other than under employer employee agreement, then that fees is taxable to the director under the head income from other sources. For example, whole time director is there. Whole time director is a full time employee of the company. So if any remuneration is received as a whole time director, that is taxable to the whole time director under the head income from salaries. But for attending board meetings, if any sitting fees is received, that is taxable under PGBP because that is out of scope of employer employee agreement. Similarly, company wants loan. Banker said banker will give loan only if director of the company gives guarantee. Now director of the company gives personal guarantee, based on that banker gave loan to the company. Now director is providing additional service apart from his employer employee agreement. He is like, other than employer employee agreement, director is also giving additional service in the form of giving personal guarantee. For that, company paid some fees to the director. That fees is taxable to the director under other sources because whatever the benefit that is received, that is out of scope of employer employee agreement. Salary of MP and MLA. See, MPs and MLAs, they are public representatives. They are not employees of government. That's why whatever the benefit that is received by MPs and MLAs from government is there, that remuneration is taxable under other sources. Yes, you can quite often see many lecturers who are teaching in college, like they will go for valuation of public exam papers, or they will set question papers for public exam. For doing such activities, if they receive any amount, that benefit is not taxable under salaries, that benefit is taxable under other sources. In a private college, lecturer is working. From private college, if any benefit is received, that is taxable under the head income from salaries because there is employer-employer relationship between private college and lecturer. But for valuing question papers, if any amount is received from government, there is no relationship of employer-employee between that government university and lecturer. That's why whatever the amount received for valuing question papers is there, that is taxable under other sources. So this we have discussed past, present or future employer. And another thing, at the same time, employee can have more than one employer and whatever the benefit that is received from all employers is there, that is taxable under the head salaries. Mr. Ramakrishna is there. Morning to afternoon, he works in Chaitanya College. Afternoon to evening, he works in Narayana College. So from Chaitanya College and Narayana College, he is receiving salary. So both the salaries are taxable to him under the head income from salaries. He is having two employers, Chaitanya College, Narayana College. Both the benefits are taxable to him under the head salaries. Next. Let us see the format in which income is computed under the head salaries. Broadly, whatever the benefits that are received by employee are there, they are classified into 5 types. If these 5 types we have discussed, then salary chapter is almost over. Okay, what are those 5 benefits? Basic payments, taxable value of retirement benefits, taxable value of perquisites, taxable value of welfare contributions, taxable value of allowances. All these 5 benefits together we call as gross salary. From gross salary, we will reduce deductions under section 16. How many deductions are there? 3 deductions are there. First one is standard deduction. Very important when doing problems of income from salaries. Many students forget to claim standard deduction. They will do entire problem, at the end they will forget to claim standard deduction. Please don't forget, claim standard deduction. Okay, under both the tax rates, default tax rates, optional tax rates, standard deduction is available. Are you able to understand? Next, section 16 to 16.3, entertainment allowance, profession tax. These benefits are available only under optional tax rates. Careful, standard deduction available under both tax rates. Entertainment allowance, profession tax. These two benefits are available only under optional tax rates. After we reduce standard deduction, entertainment allowance and profession tax, we arrive at net salary. Now let us start discussing one by one. First, I am going to start with basic payments. See, whatever the basic payments are there, these are fully taxable, no exemption, deduction, nothing. Okay, basic salary is fully taxable. Advance salary, I already told you, it is taxable in the year of receipt. Another important point, once a salary is taxed on receipt basis, again it is not taxable on due basis. Once a salary is taxed on due basis, again it is not taxable on receipt basis. Employer did not pay salary to me, but due date came. Because of due date, salary got taxed to me. In future, employer paid me salary. Again, second time it is not going to get taxed. Arrears of salary. You know arrears, right? If earlier year's salary is received in current previous year, we call that as arrears of salary. For central government employees and state government employees, there will be pay revision. Dearness allowance percentage will be increased with effective from retrospective date. So from earlier year onwards, increase in DA will be received in current previous year. So earlier years DA, because of increase in percentage received in current previous year, we call it as arrears of salary. That is also taxable under the head salaries, and it is fully taxable, no point of exemption or deduction. Bonus fees, these are also completely taxable. And whatever the commission that is received by employee, irrespective of whether commission is fixed commission or whether the commission is as a percentage of turnover, commission received by employee is also fully taxable. And whatever these basic payments are there, these are fully taxable both for government employees as well as for non-government employees. Next, let us start our discussion with regard to retirement benefits. In retirement benefits, first I am going to start with gratuity. See, whatever gratuity is there, it is the amount given by employer to employee in appreciation of the services provided by employee. Generally, we call gratuity as gracious payment. There is one act called Payment of Gratuity Act 1972. As per that act, mandatorily gratuity is required to be paid. Like some employers, even though no provisions of Gratuity Act are not applicable, still voluntarily they will pay gratuity in appreciation of the services given by employee. Now, listen carefully. Gratuity discussion, it's a bit lengthy, and at the end I am also going to discuss one problem with you with regard to gratuity, then you will get complete clarity. So if gratuity is received during the service, that means when employee is working during the course of employment, if gratuity is received, then gratuity is fully taxable irrespective of whether employee is government employee or non-government employee. If gratuity is received at the time of retirement or termination or death, what do you mean by this? After death of employee or after retirement of employee or after termination of employee, if gratuity is received. If the employee is government employee, sir, who is called as government employee? Here it was given. For the purpose of gratuity, see, whatever government employee definition is there, this definition is applicable only for gratuity. Central government employee, state government employee, local authority employees, members of civil service, you know, IAS, IPS, IFS, and defense service. So 5 category of persons. So if gratuity is received after retirement or death or termination by central government employee or state government employee or local authority employee or defense employee or member of civil service. For these 5 category of persons, after retirement, if they receive gratuity, such gratuity is fully exempt. Other employee means what? Other employee means private employee, other than those 5 category of employees. If gratuity after retirement is received by private employees, then two classifications are there. First, we have to check whether that private employee is covered under Payment of Gratuity Act or not. If private employee is covered under Payment of Gratuity Act, one type of exemption is available. If private employee is not covered under Payment of Gratuity Act, another type of exemption is available. Are you able to understand? Now, listen carefully. When I am explaining this, you will get 60 to 70% clarity, but once we do the problem, you will get complete clarity. Listen all through patiently. If private employee is covered under Payment of Gratuity Act 1972, then exemption will be allowed in 3 steps. Statutory limit 20 lakhs, or actual gratuity received, or 15 by 26 into last drawn salary into years of service. See, there are two concepts: years of service, completed years of service. Completed years of service. In case of completed years of service, if there are any extra months, we will ignore extra months. We will consider only completed years. In case of years of service, if there are extra months, if extra months are greater than 6 months, then we will round off to 1 year. I will tell one example. Employee worked for 20 years 7 months. 20 years 7 months means what? Part of the year is greater than 6 months, right? For years of service, we will consider it as 21 years. For completed years of service, we will consider only 20 years. Part of the year should be ignored when we are calculating completed years of service. So whatever 7 months are there, that those should be ignored. Another example, 20 years 4 months. See, part of the year is less than 6 months, right? So we do not do round off. For years of service, it will be 20 years. For completed years of service also, it is 20 years. My dear friends, please remember, here there is small mistake. It's not greater than or equal to, it's greater than 6 months. If part of the year is greater than 6 months, we will round it off to next year for years of service calculation. For completed years of service calculation, we will completely ignore months, and whatever the completed years are there, only those we will consider. Next. For calculation of exemption, if employee covered under Payment of Gratuity Act, then for that we consider last drawn salary. What do you mean by last drawn salary? Salary of the employee immediately preceding the month of retirement. Let's say employee retired in the month of August. We will consider July month salary as last drawn salary. And what is definition of salary? Definition of salary is basic plus any DA. Basic plus any DA means what? DA is classified into two types: DA forming part of retirement benefits plus DA not forming part of retirement benefits. Both should be considered. So basic plus any DA, we will consider it as last drawn salary. So government employee after retirement, fully exempt. Private employee, two classifications are there. If he is covered under Payment of Gratuity Act, exemption will be allowed in 3 steps. Statutory limit 20 lakhs, or actual gratuity received, or 15 by 26 into last drawn salary into years of service. Last drawn salary means salary immediately preceding the month of retirement. Salary definition for this purpose is basic plus any DA. DA forming part of retirement benefits, or DA not forming part of retirement benefits. Like first step and second step easy, third step is only critical, which you will understand once I explain the problem. Shall we see the problem? Yes. Mr. Ravi retired on 15th June 2024. When he retired 15th June 2024, after completion of 26 years 8 months. That means what? Here part of the year is greater than 6 months. So years of service 27 years. Completed years of service is only 26 years. and received gratuity of 15 lakh rupees. At the time of retirement, his salary was basic salary 15,000 per month, dearness allowance 10,000 per month, 60% of which is for retirement benefits. That means what? Here DA forming part of retirement benefits is only 60%, not forming part of retirement benefits is 40%. Commission is also given, bonus is also given. Now, compute his taxable gratuity assuming he is a private sector employee covered under Payment of Gratuity Act. If employee is covered under Payment of Gratuity Act, then exemption will be calculated in how many steps? 3 steps. What is the amount of gratuity received? Gratuity received is 15 lakhs. Shall we calculate? Gratuity received 15 lakhs. From this we need to calculate exemption. Less exemption. If employee is covered under Payment of Gratuity Act, then exemption will be calculated in how many steps? 3 steps. Step 1, statutory limit 20 lakhs. Step 2, actual gratuity received. How much is actual gratuity received? 15 lakhs. Step 3, 15 by 26 into last drawn salary into years of service. What is definition of salary if employee is covered under Payment of Gratuity Act? Basic plus any DA, correct? So how much is basic salary? Basic salary is 50,000. DA, see whether it is forming part or not forming part. Total DA we need to consider 50,000 plus 10,000, 60,000. So 15 by 26 into 60,000 into how many are years of service? 27 years, right? So 15 by 26 into 60,000 into 27 years. 9,34,615. Out of these three, whichever is lower means 9,34,615. How much is taxable gratuity? 5,65,385. That is taxable gratuity. Hope now you got clarity. So if employee is covered under Payment of Gratuity Act, exemption is calculated in 3 steps. Statutory limit 20 lakhs or actual gratuity received, or 15 by 26 into last drawn salary into years of service. If he is a government employee, at the time of retirement, whatever the gratuity received, 15 lakhs is fully exempt, correct? Now, if he is not covered under Payment of Gratuity Act, let us see provision, then we will come back. If employee is not covered under Payment of Gratuity Act, then also exemption will be calculated in 3 steps. First 2 steps are common, okay, like statutory limit 20 lakhs or actual gratuity received, or half 1 by 2 into last 10 months average salary preceding the month of retirement. Employee is retiring in the month of January. Ignore January. Take December month salary. From December month onwards, like we have to consider 10 months back. Okay, last 10 months average salary preceding the month of retirement into completed years of service. You know completed years, right? Whatever the part of the year is there, we have to ignore it. Half into last 10 months average salary into completed years of service. Salary for this purpose is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. Are you able to understand? So 1 by 2 into last 10 months average salary into completed years of service. Let us see the problem so you will get clarity. First, now employee not covered under Payment of Gratuity Act, right? Here also exemption will be calculated in 3 steps. How much is gratuity received? 15 lakhs. From this we need to calculate exemption. Step 1, statutory limit is 20 lakhs. Step 2, actual gratuity received how much? 15 lakhs. Step 3, 1 by 2 into last 10 months average salary into completed years of service. Here what is critical is calculation of last 10 months average salary. Shall we calculate? So what is definition of salary? Basic plus DA forming part of retirement benefits plus commission as a percentage of turnover. How much is basic salary? Basic salary is 50,000 per month. So 50,000 into 10 months. Next, DA. Only we have to take forming part of retirement benefits. DA forming part of retirement benefits is only 60%. 10,000 into 60% into 10 months. Commission as a percentage of turnover. How much is commission for 12 months? That means annual commission is 1 crore 20 lakhs. We do not require 12 months. We require only 10 months. So 120 lakhs into 1%, right? 120 lakhs into 1% into 10 by 12. So we have to add all these. How much? 50,000 into 10, it will be 5 lakhs. 10,000 into 60% into 10 months. How much? 60,000. 120 lakhs into 1% into 10 by 12. How much? 1 lakh. So in total it is 6,60,000. So 1 by 2 into last drawn salary, last 10 months average salary. So 6,60,000 divided by 10 months into how many completed years of service? 26 years, right? Yes. Completed years of service, 26 years. So 6,60,000 divided by 10 divided by 2 into 26. How much? 8,58,000. Out of these three, whichever is lower means 8,58,000 is the exemption. And how much is taxable gratuity? 6,42,000 is taxable gratuity. Whether answer is correct? One second. I think 6,42,000, correct. 6,42,000 is the taxable gratuity. Hope you understood now. There are some note points, let us see. So average salary means last 10 months salary preceding the month of retirement. This exemption is available only if relationship of employer and employee exists. Obviously, for a benefit to get taxed under the head salaries, there should be relationship of employer and employee. Out of that relation, if gratuity is given, then only exemption is available. Otherwise, exemption is not available. Insurance company, for doing more number of policies, insurance company gave gratuity to one of its agent. Relation between company and agent is not employer and employee. Now whatever the gratuity received by agent is there, that is fully taxable, and this exemption is not available. Exemption under section 1010 is not available. Where gratuity received by an employee from more than one employer in the same previous year or in two different previous years, aggregate exemption cannot exceed 20 lakhs. What do you mean by this? For one employee in his lifetime, maximum exemption he can claim for gratuity is 20 lakhs. That means what? First employer, he gave gratuity 3 lakhs. Total 3 lakhs exempt, for example. Total 3 lakhs was exempt. For second employer, when you are calculating statutory limit, generally how much is statutory limit? 20 lakhs. But already from first employer 3 lakhs exemption was claimed, right? So when you are calculating gratuity exemption for the second time, then you have to take statutory limit as only 7 lakhs. That means what? If earlier gratuity exemption was claimed, whatever the gratuity exemption that was already claimed is there, that should be reduced while calculating statutory limit for the second gratuity calculation. Are you able to understand? So very simple. In his lifetime, maximum gratuity exemption employee can claim is 20 lakhs. So if already exemption was claimed, that is to be reduced, and only balance is to be considered as statutory limit for second calculation of gratuity exemption. Where gratuity is received in any earlier years from former employer and again received from another employer in the later previous year, limit of 20 lakhs will be reduced by amount of gratuity exempt earlier. I already told you, right? Whatever the gratuity exemption that was already claimed is there, that should be reduced in calculation of gratuity exemption for the second time. Now, see, government employees, if they receive gratuity after retirement, fully exempt. After death of government employees, if their family members receive, even that gratuity is also fully exempt. Service I have already explained to you. One another point I have to explain. Sir, what is this 7 by 26? For regular employees, in third step, we will take 15 by 26. For seasonal employees, we will consider 7 by 26. Best example, ice cream business is there, mango business is there. Those are seasonal businesses. While calculating gratuity exemption for seasonal employees, in third step, in place of 15 by 26, we will consider 7 by 26. Now let us discuss pension. See, pension is classified into two types, uncommuted pension and commuted pension. Generally, after retirement, pension will be given. Uncommuted pension means it's a periodic pension, let's say monthly pension, quarterly pension. So, at regular intervals, pension is being received. The type of pension we call as uncommuted pension. Uncommuted pension is fully taxable irrespective of the employee. That means uncommuted pension, whether it is received by government employee or private employee, it is fully taxable. Now the whole discussion is about commuted pension. Sir, what do you mean by commuted pension? I will tell you. Listen carefully, this is important. Now, an employee is receiving 30,000 per month pension. Out of 30,000 per month pension, suddenly employee is in need of 8 lakh rupees. He wants to get one surgery done. He wants 8 lakh rupees. Employee went to his past employer and told, sir, I am ready to commute 70% of my pension. That means I am ready to give away my 70% of pension. So after he gives away 70%, how much is balance? Balance is 9,000. That means till this month he is receiving 30,000 monthly pension. From next month onwards, he will not get 30,000 per month pension. He will only get 9,000 per month pension because he gave up 70% pension. For giving up 70% pension, he asked for lump sum pension of 8 lakh rupees. Whatever this lump sum pension of 8 lakh rupees is there, this we call as commuted pension. Are you able to understand? That means for foregoing certain part of the monthly pension, in consideration if employee receives lump sum pension, that lump sum pension we call as commuted pension. Now, if this commuted pension is received by government employees, it is fully exempt under section 10 clause 10a sub clause 1. So commuted pension means nothing but lump sum pension. Why lump sum pension was received? For commutation of part of the monthly pension or for commutation of total monthly pension. If lump sum pension is received, that lump sum pension is fully exempt. If commuted pension is received by other employees means what? Non-government employees or private employees. Then if employee is not receiving gratuity, half of the pension will be allowed as exemption. If employee is receiving gratuity, then 1/3 of the pension is allowed as exemption. What do you mean by this? I will tell. Now, see here employee commuted 70%. In return he got 8 lakh rupees. So how much is commuted pension? Commuted pension is 8 lakh rupees. From this exemption is allowed. For example, let's say employee is receiving gratuity. If employee is receiving gratuity, how much exemption will be allowed? If employee is receiving gratuity, then 1/3 is allowed as exemption, right? Many people commit mistake here. See, what is being said, 1/3 of commuted value of full pension. First we need to calculate full pension. How to calculate full pension? How much is exempted? Exemption is 1/3 of full pension. Now how to calculate full pension? 8 lakhs is for how much commutation? 70%. If 100% is commuted, how much? 11,42,857. This is full pension. Out of full pension, 1/3 is allowed as exemption. 11,42,857 into 1/3. How much? 3,80,952 is allowed as exemption. How much is balance? 4,19,048. This is taxable commuted pension. Are you able to understand? So before calculating exemption, first calculate full pension. How to calculate full pension? See, formula is also given. Commuted value of full pension is equal to amount received on commutation into 100 by commutation percentage. Here how much is commutation percentage? 70%. So 8 lakh divided by 70% into 100%. Okay, or you can also write like this, 8 lakh into 100 divided by 70. This is the formula. Amount full pension is equal to amount received on commutation into 100 divided by 70%. This is the formula. Now did you understand how to calculate commuted pension? So monthly pension or quarterly pension or periodical pension that is received, that is fully taxable both for government employees and non-government employees. Commuted pension, if it is received by government employees, fully exempt. If it is received by other employees, then we have to check whether employee is receiving gratuity or not. If employee is receiving gratuity, then then 1/3 of the full value of pension is allowed as exemption. If employee is not receiving gratuity, half of the full pension is allowed as exemption. Let us solve one problem so that you will get better clarity. Mr. Sagar, who retired on 1st October 2024, is receiving 5,000 per month as pension. This type of pension we call as uncommuted pension because it is received monthly. Whatever the monthly pension is there, that we call as uncommuted pension. On 1st February 2025, he commuted 60% of his pension. That means he gave up 60% of his pension. For giving up 60% of his pension, he received lump sum pension of 3 lakhs. So this 3 lakhs we call as commuted pension. Another thing, you are required to compute his taxable pension assuming he is a government employee. See, first of all, when he is a government employee, for government employee commuted pension is fully exempt, right? Only uncommuted pension is taxable. Am I correct? Good. Now, let's say a year consists like this. 1st April 24 to 31st March 25. When he got retired on 1st October 2024. From 1st February, on 1st February he commuted 60%. That means what? 1st February 25. For 3 months, October, November, December, he received 5,000 per month pension. For February and March, 2 months, he commuted 60%, right? 5,000 minus 60%. How much? He received 2,000 per month. That means 5,000 per month into 3 months plus 2,000 per month into 2 months. How much? 5,000 into 3, 15,000. Hold on. 4 months. October to January, how many months? 4 months. So 5,000 into 4, 20,000 plus 4,000. Total 24,000. So uncommuted pension is 24,000, that is fully taxable. You can see government employee, commuted pension fully exempt. Uncommuted pension taxable is 24,000. Now, he is a private sector employee, received gratuity. So he is in receipt of gratuity. How much exemption is allowed? 1/3 is allowed as exemption. Shall we calculate? So, commuted pension. How much is commuted pension? Commuted pension is 3 lakhs less exemption. He is receiving gratuity, right? So how much exemption is allowed? 1/3 of full pension is allowed as exemption. How much is full pension? 3 lakh is received for commuting how much percentage? 60 percentage. If 100% is commuted, how much he would have received? 3 lakh divided by 60 into 100. He would have received 5 lakhs. So 5 lakhs is full pension. So 1/3 of 5 lakhs. 5 lakh into 1 by 3. How much? 1,66,667 is exemption. How much is balance? 1,33,333. Taxable value of commuted pension. So commuted pension is 1,33,333. Uncommuted pension is taxable for all, right? For government employee it is taxable. Even for private employee also it is taxable. So 1,33,333 plus 24,000. How much? 1,57,333 is taxable pension. Let us see. Hold on. Yeah, 1,57,333. 1,57,333. If he is not receiving gratuity, then in place of 1 by 3, we will consider only half. So this is homework, you try. Very simple. Let me summarize quickly. Pension, if it is uncommuted, fully taxable. Commuted, received by government employee, fully exempt. Very important here, government employee means central government employee, state government employee, local authority, even statutory corporation, road transportation corporation, it is a statutory corporation. Even those employees receive any commuted pension, fully exempt. Okay, and like defense service employees and civil service employees. Now, if commuted pension is received by private employees, we have to check if they are receiving gratuity or not receiving gratuity. Receiving gratuity, 1/3 is allowed as exemption. 1/3 of full pension. Many people commit mistake. Whatever the commuted pension is there, on that they will apply 1 by 3. No, you should not apply like that. You have to calculate full pension. On full pension, you have to apply 1 by 3 or 1 by 2. Private employee not receiving gratuity, then half is allowed as exemption. Sir, why half? Why 1 by 3? Tell me one thing, which is greater, 1 by 3 or 1 by 2? 1 by 2 is greater, right? 1 by 2 is 0.5, 1 by 3 is 0.33. See, employee receiving gratuity, he will claim gratuity exemption, right? As he is already claiming gratuity exemption, lower pension exemption is allowed. Okay, that's why 1 by 3 exemption is allowed. If employee is not receiving gratuity, then he is not claiming gratuity exemption. As he is not claiming gratuity exemption, higher pension exemption 1 by 2 is allowed. This is the logic. In examination, you forgot, you are confused. 1 by 3 or 1 by 2. Check. Employee already receiving gratuity. As he is already receiving gratuity, lower pension exemption 1/3. Employee not receiving gratuity. As he is not receiving gratuity, higher pension exemption 1/2 is allowed. So even High Court judges and Supreme Court judges also can claim exemption for commuted pension. Now, if pension is received by family members after the death of the employee, then it is taxable under other sources. I have already discussed, as there is no employer-employee relation. Now let us discuss with leave encashment. When I used to work in Infosys, per quarter there are 4 leaves to me. That means in an year, 4 quarters into 4 leaves, 16 leaves are there to me. These are paid leaves. That means if I keep 16 leaves, no salary will be cut to me. But I used to utilize total 16 leaves. Additionally, I use it to keep extra leaves also. For that, salary will be reduced to me. But there are some senior employees in Infosys only, managers. If 16 leaves are there to them, hardly they will keep 5 to 6 leaves. Remaining 10 to 11 leaves were unutilized. They used to tell, if we go home anyhow, there will be headache. It's better to be there in office than in home. They find office as more happy than home. So they used to keep less leaves. So 10 to 11 unutilized leaves are there. For these unutilized leaves, at the end of the year, additional salary will be given. So whatever the additional salary that is given for unutilized leaves is there, that we call as leave encashment. So leave encashment encashed during the service. So during the course of employment only, if leave encashment is received, then such leave encashment is fully taxable both for government employees as well as for other employees. So during the course of employment, leave encashment received fully taxable both for government employees as well as for other employees. Leave encashment after retirement or termination or death. That means if leave encashment is received after death or termination or retirement, then if it is received by government employee, fully exempt. If it is received by other employees means what? Private employees or non-government employees. Then exemption will be calculated in 4 steps. Step 1, actual leave encashment received. Step 2, statutory limit. So statutory limit for exemption for leave encashment is 25 lakhs. Step 3, 10 into last 10 months average salary. Last 10 months average salary preceding the date of retirement. Let's say today, February 6th, employee retired. From February 5th onwards, you have to take last 10 months. Last 10 months average salary preceding the date of retirement. Step 4 is cash value of unutilized leaves at the time of retirement. Cash value of unutilized leaves at the time of retirement. So first step is easy, second step is also easy, third step and fourth step are a little bit critical. Salary for this purpose is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. Here we will take only completed years. Completed years means what? If there is any part of the year, we will ignore part of the year. We will only consider completed years. The cash value of unutilized leaves at the time of retirement. So how to calculate this? That is the task. There are some steps. Listen to me. Now we have to consider maximum leaves allowed as per the organization. In Infosys, maximum leaves, for example, allowed in a year are 24 leaves. So we have to consider 24 days. As per Income Tax Act, maximum leaves allowed are 30 days. Out of these two, we need to consider whichever is lower. That means 24 days. See, in some organization, 40 days leaves will be given. But in this calculation, you should not consider 40 days. 40 or 30, whichever is lower means you will consider only 30 here. Are you able to understand? Good. So in Infosys 24 days leaves are allowed. So 24 days or 30 days, whichever is lower, we have considered 24 days. This should be multiplied with completed years. Let's say I worked for 30 years. 24 days into 30 years. How many days? 720 days. So total 720 days leaves are available to me. Out of these, I have utilized. Utilized means what? I kept a leave. I kept a leave for 480 days. So I will arrive at unutilized leaves. How many are unutilized leaves? Unutilized leaves are 240 days. See here, unutilized leaves are in terms of days, right? We need to convert to months. Unutilized leaves in terms of months. Let's say I am considering average 30 days. 240 days divided by 30 days. How much? 8 months. Let's say last 10 months average salary. For example, last 10 months average salary is 40,000. Now 40,000 into 8 months. How much? 3,20,000. This is cash value of unutilized leaves at the time of retirement. Now did you understand how to calculate cash value of unutilized leaves? First you have to take leaves as per organization policy or maximum 30 days as per income tax act, whichever is lower. So you will arrive at number of leaves per year. That should be multiplied with completed years. So you will arrive at total leaves allowed as per the employment. During employment period, total leaves you will arrive. From that you have to reduce utilized leaves. Thereby you will arrive at unutilized leaves. From unutilized leaves, you have to convert in terms of months. So those unutilized leaves in terms of months should be multiplied with last 10 months average salary to arrive at cash value of unutilized leaves. That is step 4. Hope you got clarity. Let us do one problem so that you will understand better. So last 10 months average salary into 10. Average salary means salary for last 10 months preceding the date of retirement. Salary definition is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. See here. Gupta retired on 1st December 2024. When he got retired 1st December 2024. After 20 years of service and received leave salary of 5 lakhs. So how much is leave encashment? 5 lakhs. Other details of his salary income are as follows. Basic salary 5,000 per month. 1,000 was increased with effect from 1st April 2024. What do you mean by this? Here consists of like this, right? From 1st April 2024. When he got retired on 1st December. So preceding day, what is preceding day? Preceding day is 30th November, right? So from 30th November last 10 months means from 1st February 24 up to 30th November. Okay. 1st February 24 to 30th November. February, March, April, May, June, July, August, September, October, November. Exactly 10 months. So from 1st April onwards, his salary increased by 1,000. How much is salary now? 5,000 rupees per month. That means before 1st April, his salary is only 4,000 per month, right? That's what? 4,000 plus 1,000. His salary was 5,000 rupees per month with effect from 1st April 24. Are you able to understand? See, now salary is 5,000, but what he said, from 1st April onwards 1,000 was increased. Due to increase of 1,000, now salary is 5,000. That means before 1st April his salary was 4,000. So last 10 months average basic salary is equal to 4,000 into 2 months plus 5,000 into 8 months divided by 10 months. How much is last 10 months average basic salary? 4,000 into 2, 5,000 into 8 divided by 10, 4,800. What is definition of salary? Salary for this purpose is equal to basic salary plus DA forms part of retirement benefits plus commission as a percentage of turnover. So last 10 months average salary is 4,800, correct? Now DA forming part of retirement benefits. How much is forming part of retirement benefits? 60%. That means what? 3,000 into 60% into 10 months divided by 10 months. There will be no change. Plus commission as a percentage of turnover. See, this is general commission 500 per month. What we need to consider? We need to consider commission as a percentage of turnover, that is 0. So 3,000 into 60% into 10 by 10, how much? 1800. 4,800 plus 1800, how much? 6,600. This is last 10 months average salary, correct? Now how much is leave encashment received? Leave encashment received is equal to how much? 5 lakhs, right? Is he a government employee? If he is government employee, it is fully exempt. If he is non-government employee, exemption will be allowed in 4 steps. Then exemption. Step 1, maximum exemption allowed is equal to statutory limit 25 lakhs. Step 2, actual leave encashment received how much? 5 lakhs. Step 3, 10 into 10 months average salary. How much is 10 months average salary? 6,600, 66,000. Step 4, we need to calculate cash value of unutilized leaves. How to calculate? In this question, he gave leaves availed during the year are 480 days. How many days he is eligible to? How many days he was given? 480 days leaves he was given, and as per organization 30 days leaves are allowed. Fine. See, up to 30 days, okay. If more than 30 days are given, as per Income Tax Act, they are restricted to only 30 days. So shall we calculate cash value of unutilized leaves? 30 days as per organization policy. As per income tax also 30 days, right? Whichever is lower means 30 days. How many completed years? He completed 20 years, right? 20 days. Sorry, 20 years. So leaves allowed. How many leaves are allowed? 20 into 30, 600 leaves are allowed. From this we will reduce utilized leaves. How many leaves he availed? Utilized leaves 480. That means how many unutilized leaves are there? Unutilized leaves 120. Okay, this is in terms of days. We need to convert in terms of months. 120 taking average 30 days in a month. How many months? 4 months. Now 10 months average salary. How much is 10 months average salary? 6,600. How much is cash value of unutilized leaves? 6,600 into 4 months. 26,400. This is cash value of unutilized leaves. So 26,400. Out of these 4, whichever is lower means 26,400. I think this is 5 lakhs, right? So from 5 lakhs, if you reduce 26,400, how much is taxable leave encashment? 473,600. That is the answer, right? 473,600. So did you understand how to calculate exemption for leave encashment? Another thing, maximum exemption allowed for leave encashment for an employee in his lifetime is 25 lakhs. That means in earlier years, if he has claimed leave encashment exemption, in current previous year, statutory limit is not 25 lakhs. In current previous year, statutory limit is 25 lakhs minus exemption already claimed earlier. Are you able to understand? Good. So even though in case of voluntary retirement, if any leave encashment is received, from that leave encashment exemption is allowed. Now let us discuss retrenchment compensation. See, there are many labor laws which will protect the rights of the employees. So if any employee is removed from the organization with immediate effect, or if there is any dispute, there are certain laws. Let's say Industrial Disputes Act 1947. It prescribes certain compensation. So if any compensation is paid as per the requirement of any labor laws applicable in India, such compensation we call as retrenchment compensation. So whatever the retrenchment compensation that is received, it is not fully taxable. Even from retrenchment compensation also you can claim exemption. That exemption will be allowed in 3 steps. Statutory limit 5 lakhs, or actual retrenchment compensation received, or 15 by 26 into average salary of last 3 months. So what is definition of salary? Basic plus any DA. Any DA means DA forming part of retirement benefits plus DA not forming part of retirement benefits. Last 3 months average salary preceding the date of retirement. So whatever the date of retirement is there, from that date you have to consider the preceding date. From preceding date you have to calculate 3 months. So shall we see one example so that you will understand better? So retrenchment compensation received, exemption allowed in 3 steps. Statutory limit 5 lakhs, actual retrenchment compensation received, or 15 by 26 into last 3 months average salary into into years of service. Now, Mr. Garg received retrenchment compensation. How much retrenchment compensation he received? 30 lakhs. After 30 years, for 4 months of service. So what is important for retrenchment compensation? For retrenchment compensation, important is years of service. Part of the month, part of the year is less than 6 months. So we do not do rounding off. Years of service will be 30 years. At the time of retrenchment, he was drawing basic salary of 20,000 per month and dearness allowance 5,000 per month. What is definition of salary? Basic plus any DA. So here we do not know whether it is forming part or not forming part. Still we have to consider DA because it includes any DA. Okay. So now let us see retrenchment compensation received. How much is received? 10 lakhs, right? From this we need to claim exemption. That exemption will be allowed in how many steps? That exemption will be allowed in 3 steps. Step 1, statutory limit. How much is statutory limit? 5 lakhs. Step 2, actual retrenchment compensation received. How much is actual retrenchment compensation received? 10 lakhs. Step 3, 15 by 26 into last 3 months average salary into years of service. Correct? 15 by 26 into what is definition of salary? Basic plus any DA, right? How much is basic salary? 20,000. DA is 5,000. So 20,000 into 3 plus 5,000 into 3 divided by 3. There is no change, right? Into 30. So 15 by 26 into 25,000 into 30 years. How much? 4,32,692. That is exemption. How much is taxable retrenchment compensation? 5,67,308. that is taxable retrenchment compensation. You can see. So now did you understand how to calculate retrenchment compensation exemption? See, read this point. Above limits will not be applicable to cases where compensation is paid under any scheme approved by central government for giving special protection to workmen under certain circumstances. So if any compensation is paid as per the you know scheme approved by central government, then whatever the compensation that is paid, it is fully exempt in the hands of employees. Now let us see VRS compensation. You quite often know organizations sometimes come up with the offer voluntary retirement scheme. If organization or company is having more number of employees, and if company wants to reduce its number of employees, then it will come up with the scheme voluntary retirement scheme. It is applicable for all employees. Now, whenever voluntary employment, I mean retirement scheme is announced, and you know employee opts for voluntary retirement scheme, company will give him voluntary retirement scheme compensation, and once employee receives VRS compensation, he should leave the organization. Again in his lifetime he should not again join the organization. So VRS is lump sum payment received. It can be received fully or it can be received in installments, and that can be received at the time of retirement or termination. Please remember, generally we call it as voluntary retirement scheme, and compensation received as voluntary retirement scheme compensation, VRS compensation. But if any public sector company, we do not call that scheme as VRS scheme, we call that scheme as voluntary separation scheme. So whenever you hear voluntary separation scheme, it is belonging to public sector company. For other category of companies and persons, we call that scheme as voluntary separation, voluntary retirement scheme or VRS compensation. So if any VRS compensation is received, it is not taxable 100%. From that also exemption is allowed. That exemption will be calculated in 3 steps. Statutory limit 5 lakhs, or actual VRS compensation received, or completed years into last drawn salary, or remaining months of service into last drawn salary. In third step, whichever is higher we will take. Are you able to understand? In 3 steps, whichever is lower we need to consider. That means what? Step 1, step 2, okay. In step 3 there are 2 sub steps, right? Out of these 2 sub steps, whichever is higher we will consider, and out of 3 steps, whichever is lower we have to consider. And salary for this purpose is basic plus DA forming part of retirement benefits plus commission as a percentage of turnover. Completed years of service. Completed years of service. If there is any part of the year, we will ignore part of the year. We do not round it off. Now, shall we see one problem for better understanding? Mr. Datta received voluntary retirement compensation of 7 lakhs after 30 years 4 months of service. That means what? Here what we consider? Here we consider only completed years of service. So how much are completed years of service? 30 years. He still has 6 years of service left. That means balance how many months? 6 years into 12 months. 72 months service is left. Correct? At the time of voluntary retirement, he was drawing basic salary 20,000 per month, DA which forms part of pay 5,000 per month. So basic salary 20,000, DA forming part is 5,000. Commission is not given. Compute his taxable voluntary retirement compensation. How much is voluntary retirement compensation received? 7 lakh rupees. Correct? VRS compensation received. How much is VRS compensation received? 7 lakhs. From this, exemption is allowed in how many steps? Exemption is allowed in 3 steps. Correct? Step 1, statutory limit 5 lakhs. Correct? Step 2, actual VRS compensation received. How much? 7 lakhs. In step 3, there are 2 sub steps, right? A, last drawn salary into 3 months into completed years of service. What is definition of salary? Basic plus any DA. So basic salary 20,000, DA is 5,000. 25,000 into 3 months into how many are completed years of service? 30 years, right? So 25,000 into 3 into 30 years. How much? 22.5 lakh. Or what is step B? Remaining months of service into last drawn salary. How many remaining months are there? Remaining months are 72 months, right? Correct. So 72 months into last drawn salary, how much? 25,000. 18 lakhs. Out of these two, whichever is higher, we need to take. How much is higher? 22.5 lakhs. Out of three steps, whichever is lower means 5 lakhs is allowed as exemption and balance 2 lakhs is taxable VRS compensation. So did you understand? 2 lakhs is taxable VRS compensation. Now, all employees are not eligible for exemption when VRS compensation is received. Only those employees, eligible employees, those employees who are working in these organizations, if they receive VRS compensation, then only they are eligible for VRS compensation exemption. So, employee should be either employee of a public sector company or any other company. That means company employees, if they receive VRS compensation, they are eligible for exemption. And an authority established under central, state or provincial act. That means as per any central government act or state act, if any authority is established, those employees who are working in that authority, Food Corporation of India, okay, so like it is established by state act, okay, so those employees who are working in that organization, okay, they are also eligible for VRS compensation exemption. Local authority employees, cooperative society employees, university or Indian Institute of Technology or such institute of management as central government may notify. So if central government notifies any institution or any company or organization, even that company or organization employees are also eligible for VRS exemption. Central government or state government or any institution notified by central government. So central government employees, state government employees or any institution notified by central government, okay, that institution employees, if they receive VRS compensation, they are eligible for exemption. So this exemption is available even though VRS compensation is received in installments. There is one rule called Rule 2BA. This Rule 2BA is applicable only for VRS compensation. For voluntary separation scheme given by public sector company, this Rule 2BA is not applicable. So whatever the Rule 2BA that we are going to discuss right now, it is applicable only when VRS compensation is received. If voluntary separation scheme compensation is received, then Rule 2BA is not applicable. So it prescribes that exemption under this section would be available to an employee who has completed 10 years of service or completed 40 years of age. So there are two conditions. What are they? First condition, employee should have completed 10 years of service. Condition 2, or completed 40 years of age. What is the conjunction? Conjunction is or. Out of these two conditions, if any one of the condition is satisfied. In 2004, employee joined in BSNL. At that time, his age is uh, 27 years. In 2011, he took VRS compensation. So in 2011, how much will be his age? His age will be 31. Now condition 1, did he finish 10 years? He did not finish 10 years. Condition 2, whether his age is 40 years, his age is also not 40 years. Now whenever he comes out of the organization by taking VRS compensation, for that VRS compensation he cannot claim exemption. Why he cannot claim exemption? Because he did not complete 10 years of service, or he also did not he also did not complete 40 years of age. Out of these two conditions, if any one of the condition is satisfied, then only exemption for VRS compensation is available. Another example, in 2008, an employee joined in the BSNL organization. At that time, his age is 33 years. In 2016, he retired from the BSNL by taking VRS compensation. Now in 2016, how much will be his age? His age will be 41 years. Did he finish 10 years of service? He did not, like 10 years was not completed, right? He did not finish 10 years of service, but his age is 41 years, greater than 40 years. Now if he receives any VRS compensation from BSNL, from that VRS compensation he can claim exemption. So to claim exemption, either he should have finished 10 years of service or he should have completed 40 years of age. Out of these two conditions, if any one of the condition is satisfied, then only he can claim exemption for VRS compensation. These conditions are applicable only if compensation is received for voluntary retirement scheme. If compensation is received for voluntary separation scheme under public sector company, then these conditions are not at all applicable. So I thought summarizing entire retirement benefits in a single chart. So for you, I have prepared one chart which gives comprehensive quick recap of the retirement benefits. So if employee is non-government employee and is covered under Payment of Gratuity Act 1972, statutory limit of for exemption is 20 lakhs. Salary means last drawn salary. Salary definition, basic plus any DA. That means DA forming part of retirement benefits plus DA not forming part of retirement benefits. And service year means years of service. Please don't go to the examination without reading this chart, because this is summary of all retirement benefits. You will get quite often confused about whether I have to take years of service or completed years of service, what is definition of salary, what is the statutory limit for exemption. So all these things you will have an idea once you read this chart. If employee is non-government employee and is not covered under Payment of Gratuity Act, then also statutory limit for exemption is 20 lakhs. Here salary means last 10 months average salary preceding the month of retirement. Salary definition is basic plus DA forming part of retirement benefits plus commission as a percentage of turnover, and here service means only completed years of service. For leave encashment, statutory limit for exemption is 25 lakhs. Earlier it was 3 lakhs, but later on it was increased to 25 lakhs. Salary for this purpose is last 10 months average salary preceding the date of retirement. Did you find the difference? Good. So salary definition is same, basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. And for leave encashment also, years of service means completed years of service. Retrenchment compensation statutory limit for exemption is 5 lakhs. Here what is the formula? 15 by 26 into last 3 months average salary, correct? So here 3 months average salary means, like, you have to consider 3 months average salary preceding the date of retirement. Salary definition is basic plus any DA. Service means years of service. For VRS compensation, statutory limit is 5 lakhs. Salary for this purpose is last drawn salary. Salary definition is basic plus DA forming part of retirement benefits plus commission as a percentage of turnover. And here service means you have to consider completed years of service. So next let us start with perquisites. See, perquisites are additional benefits given to the employee over and above normal salary. So apart from normal salary, if any extra facilities are provided, those extra facilities we term as perquisites. Let's say like free house was given to employee for the purpose of stay. School fees of employee children paid by employer. Free car is provided to employee for his personal purposes. All these are extra facilities provided by employer. So whatever the extra facilities provided by employer are there, those are called as perquisites. These perquisites can be given either in the form of cash or in the form of kind. And perquisites can be given completely at free of cost or at concessional rate. What do you mean by this? Let's say employee children's school fees is 50,000 rupees. Now total 50,000 rupees is paid by employer. In this case, education facility is completely provided by employer. Total fees is paid by employer. Here we can say perquisite is at like is it free of cost? Out of 50,000, 30,000 is paid by employer. Here we can say perquisite is given at concessional rate. Total 50,000 was not given and only 30,000 rupees was given. And for giving 30,000, for paying 30,000 rupees fees of employee children, employer has reduced 10,000 rupees from employee's salary. Here we can tell perquisite is given at a concessional rate. Next, only if the relationship between payer and payee is employer and employee, then only out of employer-employee relation, if any perquisite is received, then only such perquisite is taxable under the head income from salaries. If the relation between payer and payee is principal to principal relation, out of principal to principal relation, if any perquisite is received, that perquisite is taxable under the head PGBP or IFOS. I am a chartered accountant in practice. A client gave his house to me at free of cost. Why client is giving house at free of cost to me? Because I am providing financial services to him. Now I have received perquisite. He did not give me cash, but he gave me perquisite. Now whatever the rent value will be there, that is taxable to me under the head PGBP, because there is no employer-employee relationship between client and me. There is principal to principal relation. Okay. Next, perquisite will be taxable only if it has legal origin. What do you mean by this? See, only under employer authority, if any perquisite is given, then only it is taxable. Let's say employee worked for 3 years, he discontinued from the job. After discontinuance also, for 2 months, he used the house given by the employer. See, once employment gets completed, then employer-employee relation got terminated. Even after termination of employer-employee relation, employee occupied the house given by the employer. So whatever the extra period is there, that is not authorized by employer. Without notice of employer, employee occupied the house. Now for these 2 months, perquisite is not taxable, because only if employer knows it and employer authorizes it, gives permission to it, then only perquisite is taxable. After completion of employment, without notice of employer, employee stayed in the house given by employer for 2 months. Now these 2 months are not authorized by employer. So for these 2 months, perquisite is not taxable because no authorization is given by the employer. There was no legal bound. Only if there is legal bound, only if there is employer's authority, and if any facility is received, then only perquisite is taxable. So, like there are 3 types of perquisites. Some of the perquisites are taxable only in the hands of specified employees. Sir, who are specified employees? I will tell. Wait. Some of the perquisites are taxable only in the hands of specified employees. Some of the perquisites are taxable in the hands of all employees. All employees means what? Both specified and non-specified employees. Some of the perquisites are not taxable. That means those perquisites are not at all taxable. Now, let us see who is called as specified employee. See, there are 3 conditions. How many conditions? 3 conditions. So any employee who satisfies any one of the 3 conditions, that means what? All 3 conditions are not required to be satisfied. If at least one condition is satisfied, that's it. Employee becomes a specified employee. That's why the conjunction used here is or. Out of 3 conditions, if any one of the condition is satisfied, then employee becomes specified employee. First condition, employee come director. An individual who is employee in organization and also a director in the company is there, he is considered as specified employee for that company. Mr. Raju is there, he is working in ITC Limited, he is also a director of ITC Limited. That means he is holding 2 positions in ITC Limited. First position is employee, second position is director. Both the positions are held by him. Now we can call Mr. Raju as specified employee because he is employee come director. Next, an employee who has substantial interest in the company. What do you mean by substantial interest? Greater than or equal to 20% of beneficial ownership. Sir, what do you mean by this? Here, listen carefully. For a minute, I wanted to give a bit more clarity. See, any individual who is holding equity shareholding in the company, he is called as legal owner. But the person who enjoys benefit, who enjoys dividend or benefit out of those shares is there, he is called as beneficial owner. Let's say my father is holding 10,000 shares in ITC Limited. Now for those 10,000 shares, who is the owner? My father is the owner. My father is the legal owner. But my father instructed ITC Limited to pay whatever the dividend that comes on those 10,000 equity shares are there. Those dividend should be paid to me. That means my dad gave instruction to ITC Limited to pay dividend on those shares to me. In this case, I am not the owner of those 10,000 equity shares. Still, I am receiving dividend from those equity shares. In this case, I am not the legal owner, I am the beneficial owner. Are you able to understand? So what we need to consider is not legal ownership. What we need to consider is beneficial ownership for the purpose of determining substantial interest. So any individual who is having either equal to 20% or greater than 20% of beneficial ownership in a company is there, even that employee is also considered as specified employee. So an individual who is working in an organization, and in that organization this employee is having either equal to or greater than 20% of beneficial ownership, then we can say this employee is having substantial interest in that company, and that employee will be considered as specified employee. Are you able to understand? Good. Next, an employee whose income is chargeable to tax under the head salaries exceeds 50,000 per annum. See, under this clause, every employee becomes specified employee maximum. The reason is, nowadays, who is working for less than 50,000 per annum? Here it is not per month, it is per annum. That means annual salary should not exceed 50,000. Annual salary should be less than or equal to 50,000. So any employee whose income chargeable under the head salaries is less than or equal to 50,000, he is not considered as specified employee. But if his income from salaries exceeds 50,000, then he is considered as specified employee. So under C point, every employee maximum he will be considered as specified employee. So three conditions: employee come director, substantial interest in the company, or income from salaries exceeding 50,000. Out of these three conditions, if any one of the condition is satisfied, then that employee becomes specified employee. But here there is small calculation. While you are calculating this 50,000 rupees, you should reduce. That means whatever the non-monetary benefits are there, they are to be reduced. Whatever the exempted monetary benefits are there, they are also to be reduced. And deductions under section 16, three are there: standard deduction, entertainment allowance, profession tax. These two are to be reduced. So after reducing these three benefits, whatever the balance salary is there, if balance salary is greater than 50,000 rupees, then that employee will be considered as specified employee. So this is the definition of specified employee. And if employee is working with more than one employer, then salary received from all employers is to be considered in calculation of that 50,000 rupees. Now let us discuss first perquisite, rent-free accommodation. If house is given by employer to the employee, why house was given? House was given for the purpose of stay either by employee or his family members. Now that benefit received by employee we call as rent-free accommodation. So like for the purpose, now if employee wants to stay in a city, means either he has to own a house or he has to take a house on rent. But what employer is doing? Employer is asking employee to stay in the house that is given by the employer. This benefit we call as rent-free accommodation. Now this benefit is classified into 5 different types based on various cases. First case, if rent-free accommodation is received by government employee, then tax treatment is different, that I covered under part A. If rent-free accommodation is received by non-government employee, that means private employee, then two cases will arise. Private employee is receiving house from his employer for the purpose of stay. Now whatever the house that he is receiving as a rent-free accommodation, that house, if it is owned by employer, then there is different calculation that is given under part B. Whatever the house that is received as a rent-free accommodation is there, if it is hired by employer, then that is covered under part C. If hotel accommodation is given by employer to employee, different calculation is there, that is given under part D. If more than one accommodation is given, see, employee transferred from Hyderabad to Vijayawada. Already in Hyderabad, one house is given to employee. Now as he shifted to Vijayawada, here also another house was given to employee. Two houses are given to employee. So if more than one accommodation is given to a single employee, then how to value rent-free accommodation? That is given under part E. And if any temporary accommodation is given, valuation of it is given under part F. So there are 6 different cases which we need to discuss right now. See, you all know benefit is received by employee whenever free house is given by employer to employee. But how to calculate that benefit, that we are going to see right now. So what we are going to study right now, valuation of rent-free accommodation. I am going to discuss part by part. First let us see A part. A part is relating to government employee. That means if rent-free accommodation is received by government employee, how to calculate the value of benefit received by employee. See, in case of government employees, government will fix the value. Whatever the value fixed by government is there, that value we call as license fees. License fees fixed by government is considered as benefit received by employee. Let's say government employee is there, he got free quarters. Now government fixed the value of quarters license fees is 8,000 rupees per month. Now for receiving that free quarters by government employee from the government, 8,000 rupees benefit is taxable. Are you able to understand? So whatever the license fees fixed by government is there, that is taxable. In examination also, this particular topic is very easy. Why very easy? License fees will be already given in the question. Whatever the license fees given in the question is there, that is considered as taxable value. So in case of government employee, taxable value of rent-free accommodation is equal to license fees fixed by the government. From that you have to reduce amount recovered from employee. What do you mean by this? For giving free house to the employee, every month in his salary 3,000 rupees was reduced. That means value of benefit is 8,000 rupees. How much salary was reduced from his salary? 3,000 rupees. So net benefit is 5,000 rupees. That is considered as taxable value of rent-free accommodation. Are you able to understand? So government employee rent-free accommodation, very easy. Like whatever the license fee is given in the question is there, that is considered as taxable value. From that, if any amount is recovered from employee, that you have to reduce. If you reduce it, you will arrive at taxable value of rent-free accommodation. Another thing, see, there are 2 types of accommodations: unfurnished accommodation, furnished accommodation. Unfurnished accommodation means what? Only house will be given. Furnished accommodation means what? Along with house, furniture will also be given. That type of accommodation we call as furnished accommodation. See, employer is giving house. In addition to house, employer is also giving furniture. Are you able to understand? So that means what? Extra benefit is received by employee, right? So in case of furnished accommodation, whatever the value of unfurnished accommodation is there, that we will take. First we will take taxable value of unfurnished accommodation. To that we will add value of furniture. How much is value of furniture? See, if furniture is owned by employer, then we have to consider 10% of the cost. If furniture is hired by employer, then we have to consider actual hire charges paid by employer. Are you able to understand? That means what? Let's say government is giving like air conditioner to employee. That air conditioner is purchased by government. That means what? Furniture is owned by employer. Let's say value of air conditioner is 50,000 rupees. 10% of 50,000 rupees, 5,000 is considered as benefit. Are you able to understand? Let's say government took AC on rent. Government is paying 2,000 rupees rent every month, and that AC is given to employee in his house. Now employee is enjoying AC furniture in his house, but that AC is provided by employer, and that AC is not owned by employer. That AC is taken on rent by employer, and employer is paying 2,000 rupees. Now whatever the actual hire charges paid by employer is there, 2,000 rupees, that is considered as benefit received by employee. Are you able to understand? Now, in this case, I want to tell one another point. In examination, for furniture, cost is given, written down value will also be given. You should consider cost, but you should not consider written down value. That means 10%, whatever 10% is there, that should be calculated on cost. 10% should not be calculated on written down value. Are you able to understand? So very important, write down not written down value. You should not calculate value of furniture on written down value. You should calculate value of furniture on cost. Are you able to understand? So this is all about first point, rent-free accommodation given to government employee. Now, let us see accommodation provided to non-government employee. See, I am working in Infosys. Infosys gave me a flat for the purpose of my stay and my family's stay. Here, two cases will arise. Who is the owner of the flat? If the owner of the flat is Infosys, one type of calculation is there for valuation of rent-free accommodation. If flat is taken on rent by Infosys, then there is another type of calculation for the purpose of calculation of rent-free accommodation. Now, I am going to discuss the case where flat is owned by Infosys. That means whenever house is owned by employer, then how to calculate value of rent-free accommodation, that I am going to discuss with you right now. First, let us discuss for unfurnished accommodation. That means what? House is owned by employer and that house is given to the employee for the purpose of his stay. In this case, how to calculate rent-free accommodation? If he is government employee, already we have seen how to calculate. If he is non-government employee and house is owned by employer, then we have to check the population. Sir, where we have to check the population? In which city we have to check the population? You have to check the population in the city where accommodation is given. Are you able to understand? Let's say I am living, like, office is there in Vijayawada. Accommodation is given in Mangalagiri. So basically Mangalagiri is 20 kilometers from Vijayawada. Now employee is working in Vijayawada because office is located in Vijayawada. But where house is located? House is located in Mangalagiri and that house is owned by employer. Now you have to consider the population. In which city you have to consider the population? You have to consider the population where accommodation is given, not where employee is working. Are you able to understand? So you have to consider accommodation in Mangalagiri. So in Mangalagiri, if population is less than or equal to 15 lakhs, then taxable value is equal to 5% of salary. In Mangalagiri, if population is greater than 15 lakhs but less than or equal to 40 lakhs, then you have to consider 7.5% of salary. In Mangalagiri, if population is greater than 40 lakhs, then you have to consider 10% of salary. Are you able to understand? So, if rent-free accommodation is given to non-government employee and that house is owned by employer, then you have to consider the population in the city where accommodation is given, not in the city where employee is working. In that city, if population is less than or equal to 15 lakhs, then taxable value is equal to 5% of salary. If population less than or equal to, if population is greater than 15 lakhs but less than or equal to 40 lakhs, taxable value is equal to 7.5% of salary. If population is greater than 40 lakhs, then taxable value is equal to 10% of salary. This is value of unfurnished accommodation. That means only if house is given, this is the value you have to, this is how you have to calculate the value. Along with house, that means what? Let's say Infosys is in Vijayawada. Infosys has one flat in Mangalagiri. That flat is given to me as I am the Infosys employee. Along with flat, Infosys also gave air conditioner, TV and one sofa. That means what? Furniture is also given by Infosys. Now, whatever the flat that is given to me, that is not unfurnished accommodation, that is furnished accommodation. So in case of furnished accommodation, how to calculate the taxable value? First, you will consider taxable value of unfurnished accommodation. So you know, right, this is how you have to calculate. First, you will consider taxable value of flat. Unfurnished accommodation means flat. Next, you will add value of furniture. That means TV, AC and sofa. Like if these three are owned by employer, then you will consider 10% of the cost. If these three are hired by Infosys, then whatever the rent charges that are paid by Infosys is there, that will be considered. So if furniture is owned by employer, taxable value is equal to 10% of cost. If furniture is hired by employer, taxable value is equal to actual hire charges. From this, if any amount is recovered from employee, that means for giving me flat and for giving me furniture, every month in my salary 7,000 rupees was reduced. Whatever the amount of salary that is reduced from employee salary is there, that is to be reduced. So net you will arrive at a taxable value of rent-free accommodation. Are you able to understand? So this is the calculation for furnished accommodation. We have seen case 1 where house is owned by employer. If house is hired by employer, accommodation is taken on lease or rent by employer. Now, I am working in Vijayawada in Infosys. Infosys gave a flat to me in Mangalgiri. Whatever the flat that is given to me is there, that is not owned by Infosys, that is taken on rent by Infosys. Every month, Infosys is paying 12,000 rupees rent to the employer. Now, whatever the free house that is given to me, that is not owned by employer, that is hired by employer. So whenever it is taken on lease by the employer, then how to calculate for unfurnished accommodation? Taxable value is equal to actual lease rent paid by employer or 10% of salary, whichever is lower. So out of these two, whichever is lower, we need to consider. So every month how much Infosys is paying? 12,000 rupees rent, correct? So you have to consider 12,000 rupees rent or 10% of my salary, whichever is lower. Are you able to understand? And another thing, for giving me that flat, if any salary is reduced from my, any amount is reduced from my salary, that is to be reduced. Amount recovered from employee is to be reduced. That's how you will arrive at taxable value of perquisite. So whenever house is taken on rent by employer and if that house is given to the employee, then taxable value of unfurnished accommodation is equal to actual hire charges paid by employer or 10% of the salary, whichever is lower. If any amount is recovered from employee, that should be reduced. Thereby you will arrive at taxable value of unfurnished accommodation. Now, taxable value of furnished accommodation. That means what? Infosys took one flat on rent for 12,000 rupees and that flat is given to me being an employee. Along with that flat, furniture is also given. See, value of furniture in any case is same. Very easy. If furniture is owned by employer, you will consider 10% of the cost. If furniture is hired by employer, then whatever the hire charges that employer is paying, that you will consider. Are you able to understand? And in every case, one another point is also common. If any amount is recovered from employee, if any amount is reduced from employee's salary, that will also to be reduced from value of the benefit or perquisite. Next, if hotel accommodation, that means if accommodation is provided by employer, let's say I am working in Infosys in Vijayawada. Infosys called and asked me to shift from Vijayawada to Hyderabad. So what I did now I shifted my my home from Vijayawada to Hyderabad. Why I shifted? Because like I got transferred from Vijayawada to Hyderabad. When I go to Hyderabad, initially I will not have any house. So employer gave 10 days hotel accommodation. That means for 10 days, employer Infosys booked a hotel for me. That means what? See, for the purpose of 10 days, as I newly came to Hyderabad, free accommodation is given by employer, and that free accommodation is given in a hotel. So whenever free accommodation is given in a hotel, like, of course, hotel is a furnished accommodation, right? They will not give only room. Along with room, furniture will also be given. So whenever hotel is given to the employee, then value of rent-free accommodation is equal to 24% of the salary or actual hotel charges paid, whichever is lower. You know, once you qualify chartered accountancy and go for campus placement, in campus placement, if you get selected, then employer along with your joining letter, he will also send a voucher for hotel stay. Let's say my friend recently got job in one MNC company. Along with joining letter, he received 15 days Novotel voucher. That means he can freely stay in Novotel for a period of 15 days from the date of his joining. Are you able to understand? So that means what? As employees are newly joining or as employees are transferring from one location to another location, free accommodation, free hotel accommodation is provided by employer. Even that is also benefit received by employee, right? But in aggregate, if that free accommodation is received for 15 days, then that benefit is not taxable. Whatever the free hotel accommodation that is received for more than 15 days is there, that is taxable. Sir, how much is taxable? So if hotel accommodation is received for more than 15 days, then taxable value is equal to actual hotel charges paid by employer or 24% of the salary, whichever is lower. Let's say in Novotel per day room is 7,000 rupees. He received for 15 days, right? How much 7,000 into 15 means? 1,05,000. 1,05,000 or 24% of salary, whichever is lower, will be considered as taxable value of rent-free accommodation. Is it clear? Good. If more than one accommodation is provided, what do you mean by this? Employee, like, okay, I will tell this example. I got transferred from Vijayawada to Hyderabad. In Vijayawada, in Mangalgiri, one house is given to me. As a, like, my family is there in Vijayawada, immediately I cannot shift them, but I have to do the work. So I went to Hyderabad. In Hyderabad also, they gave one house to me. That means Infosys gave to me one house in Mangalgiri and one house in Hyderabad. Two accommodations are given. So if two accommodations are given, or as a provision, if more than one accommodation is given to the employee, in such a case, if more than one accommodation is given for 90 days, then out of two accommodations, only one accommodation is taxable. So what I will do, I will calculate taxable value for house in Mangalgiri. I will also calculate taxable value for house in Hyderabad. Wherever I am getting lower taxable value, I will make that taxed. Are you able to understand? So that is beneficial to me. So if more than one accommodation is given to the employee, in such a case, for the first 90 days, out of two accommodations, which accommodation is having lower taxable value, that will be taxed. But after 90 days, both accommodations will be taxable. That means what? Up to 90 days, out of Mangalgiri house or Hyderabad house, which is getting lower taxable value, that I will consider in calculation of salary. But after 90 days, Hyderabad rent-free accommodation is taxable, Mangalgiri rent-free accommodation is also taxable. Now, we finished our discussion with regard to government employee, non-government employee, accommodation owned by employer finished, accommodation hired by employer also finished, hotel accommodation we have finished, more than one accommodation also we have finished. Now we have to discuss temporary accommodation. See, if any accommodation is given on a temporary basis, that accommodation is not taxable. When that accommodation is not taxable, nothing is taxable if an accommodation is temporarily provided to an employee working at a mining site or an onshore oil exploration site or a project execution site or a dam site or a power generation site or an offshore site. That means temporary accommodation given is not taxable. When it is not taxable, if temporary accommodation is given to an employee who is working in onshore oil exploration site or dam site, project execution site or offshore site. That means in these places, if temporary accommodation is given, that is not taxable. But there are two conditions. The conjunction is or, that means out of these two conditions, if any one of the condition is satisfied, then that benefit is not taxable. Very simple. Temporary accommodation given, not taxable. When it is not taxable, if the temporary accommodation is given to employees who are working in onshore site or offshore site or dam site or project execution site, in these places only if temporary accommodation is given, then it is not taxable. But there is condition. What is that condition? Like two conditions are there. Out of two conditions, any one of the condition is satisfied, then that benefit is not taxable. Let us read. Such accommodation having plinth area not exceeding 1000 square feet is located at least 8 kilometers away from the local limits of a municipality or a cantonment board, or such accommodation of any size is in remote area. What do you mean by this? Let's say temporary accommodation was given. It is not taxable, right? But two conditions are there. Condition 1, condition 2. For condition 1, area. Area means what? Whatever the rent-free accommodation is given is there, the area of rent-free accommodation should be less than or equal to 1000 square feet. That's what, right? Should be less than or equal to 1000 square feet. And location. Location of rent-free accommodation. Where it should be? Location of rent-free accommodation should be at least 8 kilometers away from the municipality. Away from municipality. Condition 2, accommodation can be of any size in remote area. That means for condition 2, area can be of any size. There is no restriction. Area can be of any size, but location should be in remote area. What do you mean by this? If temporary accommodation is given for those employees who are working in those places, okay, oil exploration, project execution, dam site, then if the temporary accommodation is provided, we have to check the area. If the area of rent-free accommodation is less than 1000 square feet, less than or equal to 1000 square feet, and the location of the temporary accommodation is 8 kilometers away from the municipality. That means what? Let's say this is Vijayawada municipality. You have to consider end. From this end, you have to consider 8 kilometers. After this 8 kilometers, if temporary accommodation is given, and if the temporary accommodation area is less than or equal to 1000 square feet, then the temporary accommodation is not taxable. Are you able to understand? So if temporary accommodation is provided to employees who are working in dam sites or project execution sites, if that temporary accommodation is provided 8 kilometers away from the municipality and area of accommodation is less than or equal to 1000 square feet, then the temporary accommodation is not taxable. That is condition 1. Second, if temporary accommodation is provided in a remote area, then also temporary accommodation is not taxable. What do you mean by remote area? Remote area for this purpose means any area which is not located within the local limits or with a distance of 30 kilometers measured aerially of local limits of any municipality or a cantonment board having population of 1 lakh or more based on 2011 census. What do you mean by this? Let's say there is a municipality. In this municipality, population is greater than 1 lakh. Now you have to take, and there will be limits, right? Limits for municipality. If you take Vijayawada city, there are boundaries. So for every municipality, there are boundaries. You have to take end of the municipality. From end of municipality, you have to calculate 30 kilometers. After 30 kilometers, whatever the area is there, that area we call as remote area. In remote area, if any temporary accommodation is given, such temporary accommodation is also not taxable. Let me quickly revise. Temporary accommodation not taxable. When it is not taxable, if the temporary accommodation is given to employees who are working in onshore oil exploration sites or dam sites or project execution sites. But there are two conditions. If any one of the condition is satisfied, then only temporary accommodation is not taxable. Condition 1. Temporary accommodation is given in a place which is 8 kilometers away from the local municipality and area of rent free accommodation is less than or equal to 1000 square feet. Now in that place, if temporary accommodation is given, it is not taxable. Or if temporary accommodation is given in remote area, the area of accommodation can be of any size, but if temporary accommodation is given in remote area, then also it is not taxable. Now let us see other important points. For Supreme Court judges and High Court judges, if any rent free accommodation is given, that benefit is not taxable, but the only condition is this benefit is available to High Court judges and Supreme Court judges only if they are paying taxes under optional tax rates. Supreme Court judge is paying tax under default tax rates. Rent free accommodation is taxable, it is not exempt. Rent free accommodation is exempt only if High Court judges and Supreme Court judges are paying taxes under optional tax rates. Is it clear? Next. Perquisite is taxable only for the period for which accommodation is occupied by employee. What do you mean by this? Infosys gave flat to me for the purpose of stay. I told Infosys, hey Infosys, I am already having a house in Vijayawada. Why I have to go to Mangalgiri and stay in the flat given by you? I will not stay there. Okay, that means what? Although Infosys offered rent-free accommodation to me, I did not utilize it. I denied it. But what happened? We are reconstructing our own house. That means I am collapsing this existing building and reconstructing the new building. So from October to December, 3 months, I utilized the house given by Infosys in Mangalgiri. Now only for these 3 months rent-free accommodation is taxable. Even the rent-free accommodation is given by Infosys to me for 12 months, I did not utilize it. Okay, I denied the offer, but I accepted the offer only for a period of 3 months. Now only for these 3 months rent-free accommodation is taxable. And another important point, rent-free accommodation is taxable for these 3 months, right? In formulas we have seen like 5% of salary, 10% of salary, 7.5% of salary. So when you are calculating taxable value of rent-free accommodation, these 3 months salary only you have to consider. On 3 months salary, you have to apply 5% or 7.5% or 10%. That means what? If accommodation is not occupied by employee for the whole year and accommodation is occupied only for a specified period, for that specified period only we will calculate rent-free accommodation, and for calculation of rent-free accommodation for that specified period, whatever the salary is there, only that salary we will take for the calculation. Is it clear? For calculation of rent-free accommodation, salary accrued for the period for which accommodation is occupied by employee. That means what? I have occupied house in Mangalgiri for 3 months. So I will also consider only 3 months salary. On this 3 months salary only I will apply 5%, 7.5% or 10%. From last 20-25 minutes onwards, I am discussing salary. Sir, what is salary? For rent-free accommodation, salary calculation is different. For the purpose of valuation of rent-free accommodation, salary includes all benefits. Basic salary, DA forming part of retirement benefits, bonus, commission, fees, all taxable allowances, any monetary benefit which is chargeable to tax. Simple. Salary includes all amounts which are chargeable under the head salaries, but exclusions are important. These 5 items are to be excluded from salary when you are calculating taxable value of rent-free accommodation. See, you know DA, right? Dearness allowance. DA is of 2 types. Forming part of retirement benefits, not forming part of retirement benefits. So whatever DA not forming part of retirement benefits is there, that should not be considered in calculation of salary. That means I am calculating salary. I found DA not forming part of retirement benefits. Exclude it. Whatever DA not forming part of retirement benefits is there, that is to be excluded from total salary. and employer contribution to Provident Fund and interest thereon. Next we are going to study welfare contributions. At that time you will understand. So whatever employer contribution to recognized Provident Fund and interest on employer contribution is there, it is taxable under the head salaries. But that amount you should not consider. That amount is to be excluded from salary only for the purpose of calculation of rent-free accommodation. See, generally we will calculate income from salaries. That is different. For the purpose of calculation of rent-free accommodation, you have to calculate salary separately. Whatever the salary that is calculated separately is there, on that salary you have to apply 5%, 7.5% or 10%. Are you able to understand? So for rent-free accommodation, you have to calculate salary separately. And when you are calculating that salary, don't consider, exclude DA not forming part of retirement benefits, exclude employer contribution to Provident Fund, also exclude interest on that employer contribution. Next, exempted allowances. Whatever the exempted allowances are there, they are also to be excluded. For example, education allowance is there. It is exempt up to 100 rupees per month for maximum 2 children. Hostel allowance is there. It is exempt up to 300 per month up to a maximum of 3 children. Whatever the exempted amount of allowance is there, that is also to be excluded from salary. Perquisites. Right now we are studying perquisites, right? Whatever the other perquisites are there, education facility, medical facility, they are also to be excluded in calculation of salary. Retirement benefits, we have discussed retrenchment compensation, leave encashment, VRS, all these are to be excluded. So only for the purpose of rent-free accommodation, you have to calculate salary separately. In that salary calculation, don't consider DA not forming part of retirement benefits, don't consider employer contribution to Provident Fund, don't consider interest on employer contribution, don't consider exempted allowances, don't consider perquisites, don't consider retirement benefits. After excluding these 5 items, whatever the balance salary is there, on that balance salary you will apply, you will do the calculation of rent-free accommodation. As we discussed rent-free accommodation, now let us see one problem for better understanding. In case of Mr. Marco, employer provides own accommodation. Own accommodation is provided by employer. Well furnished at Delhi. In Delhi, obviously the population is greater than 40 lakhs, right? The written down value of the furniture works out to 3000. See, question, written down value was given and cost also given. You have to apply 10% on cost or written down value. We have to apply 10% on cost. Marco draws 15,000 per month basic salary and 2,500 per month as monthly commission. Calculate taxable value of perquisite of rent-free accommodation. First of all, this is a furnished accommodation. Furniture is also provided to Marco, and Marco is not a government employee. He is a non-government employee. In such a case, first, value of unfurnished accommodation. Population is less than or equal to 15 lakhs, then 5%. Greater than 15, up to 40 lakhs, then 7.5%. Greater than 40, calculation, taxable value is equal to 10% of salary. So here population is obviously greater than 40 lakhs. So taxable value of unfurnished accommodation. Taxable value of unfurnished accommodation is equal to 10% of salary, right? So how much is salary? Salary includes all benefits but excludes 5 items. So here only 2 are there. Basic salary is included in salary, commission is also included. So 15,000 plus 2,500. So 10% of 15,000 plus 2,500 into 12 months. How much? 17,500 into 12 into 10%. How much? 21,000. That is taxable value of unfurnished accommodation. To this we will add taxable value of furniture. We have to consider cost, right? How much is value of furniture? Furniture is 3,000 rupees. Written down value, cost is 2,700. Many people commit mistake here. They will take written down value. You should not take written down value. I will also tell why they take written down value, because for calculation of depreciation generally we will apply percentage on written down value. Okay, so subconsciously they will apply percentage on written down value. You should not like that. Consciously, rent free accommodation 10% should be applied on cost. Okay, so how much? 27,000 into 10%, it will be 2,700. Then 23,700, that is value of rent free accommodation. Are you able to understand? Next, instead of providing accommodation free of rent, employer charges 1,500 per month as rent from Mr. Marco. That means what? For giving house along with furniture, every month 1,500 rupees is reduced from employee's salary. That means 1,500 is recovered from employee. Whatever the amount recovered from employee is there, that should be reduced in calculation of perquisite. So how much is recovered? Less amount recovered from employee. 1,500 per month, right? Amount recovered from employee. 1,500 into 12. 18,000. Minus 23,700. 5,700 is taxable value of rent-free accommodation. What is your answer if rent payable by Marco to his employer is 2,000 per month? What do you mean by this? Instead of 1,500 per month, if rent is 2,000 per month, 2,000 into 12, it will be 24,000, correct? If it is 24,000, then the answer is negative, right? Answer is minus 300. In this case, you should not consider minus 300. The taxable value of perquisite is nil. Are you able to understand? So if taxable value of rent-free accommodation is negative, then you have to consider taxable value of rent-free accommodation as 0. Next, inflation linked valuation if same accommodation is provided for more than 1 year. Listen, same accommodation is given to employee for more than 1 year. Infosys gave me a flat in Mangalgiri last year. The same flat is also given to me in current previous year. So if same rent free accommodation, if same accommodation is given to the employee for more than 1 year, then you have to consider inflation also. Like inflation is also to be considered in calculation of taxable value of rent free accommodation. I will tell. So if more than, sorry, if same accommodation is given to employee for more than 1 year, then taxable value of rent free accommodation is equal to rent free accommodation as per provisions or inflated rent of first previous year, inflated rent of first previous year, whichever is lower. That means whenever the same accommodation is continuously given to employee for more than 1 year, from second year onwards, taxable value of rent-free accommodation is equal to rent-free accommodation as per provisions or inflated rent of first previous year, whichever is lower. Don't be tensed. We will do one problem, then you will get clarity. Have patience. Listen completely till the end. Now here first previous year means previous year 23-24 or first year of accommodation occupied by employee, whichever is later, whichever is later. So this is provision. Now let us solve one problem. Through the problem, I will make you understand this concept. Yeah, another note point also. Here, inflated rent of first previous year. What is inflated rent of first previous year? Inflated rent of first previous year is equal to rent of first previous year into cost inflation index of current previous year divided by cost inflation index of first previous year. This is the formula. You may not understand now, but once we finish the problem, you will get clarity. X is a chief financial officer of A Limited. Since 1st April 2024, when he joined A Limited for the first time, when he is joining A Limited for the first time, 1st April 2024, that means he joined A Limited in previous year 24-25, correct? And posted in Mumbai. He gets following salary or allowance or perquisite. Salary per month, carefully, 5 lakhs. It is not per annum, per month salary. Salary per month, 5 lakhs. Special allowance per month, 50,000. Total salary is 5,50,000. Rent-free house provided to X in Mumbai, where accommodation is provided Mumbai. Now we have to check whether that accommodation is owned by employer or hired by employer. House is owned by employer. If house is owned by employer, we have to check the population in a city where accommodation is given. Here accommodation is given in Mumbai. So in Mumbai, obviously population is greater than 40 lakhs, right? Whenever the population is greater than 40 lakhs, taxable value is equal to 10% of salary. And furniture is also provided. That furniture is owned by employer and the value of furniture is 8 lakhs. So shall we calculate for previous year 24-25? Is it a furnished accommodation or unfurnished accommodation? It is furnished accommodation because furniture was also given. So taxable value of furnished accommodation. First we have to calculate taxable value of unfurnished accommodation. How much is unfurnished accommodation? 10% of salary, right? So how much is salary? 5,50,000 into 12 months into 10%. See, both are to be considered, salary and special allowance. 5,50,000 into 12 into 10%. How much? 6,60,000. This is taxable value of unfurnished accommodation. To this we need to add value of furniture. Whether furniture is owned by employer or hired by employer. Furniture is owned by employer, right? So 8 lakhs into 10%, how much? 80,000. So how much is taxable value of furnished accommodation? Six lakh 60,000 plus 80,000, total 7,40,000. That is taxable value of furnished accommodation. Correct? Now, second year in 25-26, salary is 5,60,000, special allowance 55,000, total 6,15,000. See, same house is given to X in second financial year also. Whenever same house is given in second financial year, taxable value of rent-free accommodation is equal to, in 25-26, taxable value of rent-free accommodation is equal to rent-free accommodation as per provisions or inflated rent of first previous year, whichever is lower. Here first previous year means 23-24 or first year of occupation. When this house was first occupied for the first time, it is occupied in 24-25, right? So 23, 24 or 24, 25, whichever is later. Whichever is later means first previous year is 24, 25. Correct? Now, let us calculate rent-free accommodation as per provisions. Rent-free accommodation as per provisions. Taxable value of furnished accommodation. First, let us calculate taxable value of unfurnished accommodation. See, accommodation is given in Mumbai, right? So, taxable value of unfurnished accommodation is 10% of salary. How much is salary? 6,15,000. Correct? Salary is 6,15,000. So, 6,15,000 into 12 months into 10%. How much? 7,38,000. To this we need to add furniture value, right? How much is furniture value? 80,000. We did calculation in previous problem. 7,30,000 plus 80,000, 8,18,000. So this is taxable value of rent-free accommodation as per provisions. Correct? See, as per provisions, taxable value of rent-free accommodation is 8,18,000. Now, shall we calculate inflated rent? Inflated rent of first previous year. Here one small change. Here it is not rent of first previous year. Please write down taxable value of rent-free accommodation for first previous year. Taxable value of rent-free accommodation for first previous year. How much is, this is first previous year, right? 24, 25. How much is taxable value of rent-free accommodation for first previous year? 7,40,000, correct? So 7,40,000 into cost inflation index for current previous year. Currently we are doing for 25, 26, right? Cost inflation index for 25, 26 divided by cost inflation index for 24, 25, because first previous year is 24, 25. Cost inflation index was given 25, 26 it is 392. For 24, 25 it is 363. So 7,40,000 into how much is cost inflation index? 392, right? 392 divided by 363. How much? It is 7,99,118. So again, let us come back to the formula. Taxable value of rent-free accommodation is equal to rent-free accommodation as per provisions. As per provisions, how much is rent-free accommodation? 8,18,000. 8,18,000. How much is inflated rent? Inflated rent is 7,99,118. 7,99,118. Out of these two, whichever is lower means 7,99,118. Are you able to understand? You can see here. As per provisions, it is 8,18,000. 8,18,000 or 7,99,118. Whichever is lower means 7,99,118 is taxable value of rent-free accommodation. Now, did you understand? So, if same accommodation is provided for more than 1 year, then taxable value of rent-free accommodation is equal to rent-free accommodation as per provisions or inflated rent of first previous year, whichever is lower. Write down here, it is more appropriate. Instead of calling inflated rent, let us call it as inflated rent-free accommodation of first previous year. That is meaningful. Inflated rent-free accommodation of first previous year. inflated rent-free accommodation of first previous year. So third one, 26-27. In 26-27, salary is 5,85,000 plus 55,000. Salary is 6,40,000. So how much will be taxable value of unfurnished accommodation? 6,40,000, right? Salary 6,40,000. Yes. Into 12 months into 10%. So currently we are doing for 26-27. Okay. 25-26 or we are doing for 26-27. 6,40,000 into 12 into 10%. How much? 7,68,000. So 7,68,000. Value of furniture 80,000. How much? 8,48,000. Now, yeah, taxable value of rent-free accommodation of first previous year into cost inflation index for current previous year divided by cost inflation index for 24-25. So for first previous year, how much is rent-free accommodation? 7,40,000, right? First previous year, 7,40,000 into current previous year, that means 26-27, 24-25. So 7,40,000 into how much is index number for 26-27? 416. 416 divided by 24-25. How much? 24-25. It is 363. 363. So 7,40,000 into 416 divided by 363. How much? 8,48,044. Is it correct? Yes, 8,48,044. Now, taxable value of rent-free accommodation is equal to rent-free accommodation as per provisions or inflated rent-free accommodation of first previous year. Whichever is lower. How much is rent-free accommodation as per provisions? 8,48,000, right? 8,48,000 or inflated one 8,48,044. Whichever is lower means 8,48,000 will be taxable value of rent-free accommodation. Simple. Taxable value of rent-free accommodation is equal to rent-free accommodation as per the provisions or inflated rent-free accommodation of first previous year, whichever is lower. See this concept, whatever this concept is there, this concept is applicable only if the same house is given for more than one previous year. Are you able to understand? Good. Domestic servant facility. See, if domestic servants are provided by employer to employee, it is also benefit received by employee. For example, chef is provided, watchman is provided, housekeeping staff was provided, gardener was provided. Generally, employee has to pay for all these assistants, all these servants. But who is paying salaries of all these people? Employer is paying salaries of all these people. Then it is benefit received by employee, right? So that benefit is taxable to the employee as a perquisite. Chef salary is 10,000 rupees per month. Actually, employee from his pocket he has to pay. But 10,000 rupees who is paying? Employer is paying 10,000 rupees to chef of the employee. That means that is also benefit received by employee. That benefit is taxable as perquisite. If whatever the servants are there, whoever the servants are there, if servants are appointed by employer and salary is also paid by employer, then that benefit is taxable only for specified employee. Are you able to understand? If servants are appointed by employee and salary is paid or reimbursed by employer, then that benefit is taxable for all employees. Chef appointed by employee, salary is paid by employer. This benefit is taxable for all employees. Chef appointed by employer and salary also paid by employer. This benefit is taxable only for specified employees. What is the amount that is taxable as benefit? Whatever the salary paid by employer to domestic servant is there, that amount is taxable as perquisite. So salary paid by employer minus amount recovered from employee. That means for providing domestic servant facility, if any amount is reduced from employee salary, that amount is to be reduced from value of perquisite. Are you able to understand? Next. Domestic servant allowance. Allowance means what? Every month 20,000 rupees is given to employee. How many servants that employee wants, he can appoint out of the 20,000 rupees. That means if lump sum amount is given for domestic servants, then that we call as domestic servant allowance. Domestic servant allowance is fully taxable in the hands of employee. Next. Gas, water and electricity facility. See, gas connection, water connection, electricity connection, these three are in the name of employer and bills are also paid by employer. In this case, the benefit is taxable only in the hands of specified employees. See, I am living in employee quarters. In employee quarters, electricity connection, water connection, gas connection is in the name of employer only. Are you able to understand? Now, these bills are also paid by employer. Now, benefit is received by me. I am using water facility, gas facility, electricity facility at free of cost. Now, this benefit is taxable only if I am a specified employee. Are you able to understand? Now, see, those employees who are living in employee quarters, they are enjoying all these benefits. Some of the employees are not there in employee quarters because there is no place, so they are living outside the employee quarters. Now, employer is paying gas bills, water bills, electricity bills of those who are staying in employee quarters. Those employees who are staying outside India, they started doing protest. Sir, you are taking care of electricity facility, water facility and gas facility of employees living in employee quarters. What about us? So employer told whatever the bills are there, your bills, electricity bills, water bills, gas bills, provide in front of me. I will pay all those bills. So now employees are taking house on rent and living separately apart from employee quarters. In those places, employee has taken separate gas connection, water connection and electricity connection. That means in this case, gas connection, water connection and electricity connection are in the name of employee and bills are paid or reimbursed by employer. In this case, the benefit is taxable in the hands of all employees. Are you able to understand? Simple. Connection in the name of employee, bills paid by employer, taxable in the hands of all employees. Connection in the name of employer, bills paid by employer, taxable in the hands of only specified employees. How much amount is taxable? Whatever the bills that are paid, the actual paid bills amount is taxable. Actual charges paid by employer minus amount recovered from employee. Let's say current bill is 8,000 rupees. 8,000 rupees is paid by employer. Now 8,000 is benefit received by employee, right? For paying electricity bill of 8,000 rupees, 3,000 rupees is reduced from employee salary. Now how much amount is recovered from employee? 3,000 rupees. That is to be reduced. So net benefit to employee is 5,000 rupees. Are you able to understand? So whatever the charges paid by employer are there, from that amount recovered is to be reduced and only balance amount is taxable as perquisite. Next. Gas, water, electricity facility produced by employer. HB gas is there. HB gas manufactures gas. HB gas told its employees every month 2 electricity cylinders you can take. That means what? Employer is producing gas and whatever the gas that is produced by employer is there, that is given to employees at free of cost. Every month 2 cylinders are given. Now HP gas employee, every month he can take 2 cylinders to his home for the purpose of cooking. In this case, benefit is received by HP gas employee. Normally, if he wants to purchase HP gas, then monthly sale price of each cylinder is 1,000 rupees. He need to pay 1,000 rupees and he need to purchase the cylinder. Now, as he is working in HP, he got free cylinder, 2 free cylinders per month. That means benefit is received by employee, right? Now, how to calculate the benefit? Benefit is equal to manufacturing cost of facility provided less amount recovered from employee. Important. What is to be considered? What is to be considered is manufacturing cost, not sale price. See, sale price of cylinder is 1000 rupees, but there will be profit, right? Let's say profit is 100 rupees, manufacturing cost is 900 rupees. What is taxable is not 1000 rupees. What is taxable is 900 rupees. Are you able to understand? So if gas connection, electricity connection, water connection, water facility, gas facility, water facility, electricity facility, if these are provided by employer from his own resources, then taxable value to the employee is equal to manufacturing cost incurred by employer. If any amount is recovered from employee, whatever the amount recovered from employee is there, that is to be reduced from manufacturing cost. Next, education facility. See, employee children, they are studying in a private school or they are studying in a school which is not owned by employer. And whatever the fees of employee children is there, it is paid by employer. Are you able to understand? Then that benefit is taxable for all employees. You can see if school fees of employees children or employees household paid or reimbursed by employer. That means education facility can be given to any family member of employee. Education facility can be given to employees children or any other family members of employee. But if entire fees is paid by employer, then that benefit is taxable in the hands of all employees. What is taxable value? Taxable value is equal to amount of fees paid by employer minus amount recovered from employee. Employee son studying in Delhi public school. Fees per annum is 4 lakhs. Total 4 lakhs fees is paid by employer. For providing this education facility, 60,000 rupees is reduced from employee salary. Now how much is taxable? 4 lakhs is the benefit received. For that benefit, how much amount is reduced from salary? 60,000. So net benefit is equal to 3.6 lakhs. That is taxable as perquisite. So if education facility is provided by employer in a school other than the school owned by employer, okay, that means in private schools or private educational institutions, if any educational, if any educational facility is provided by employer either to employees children or family members of employee, then that benefit is taxable for all employees. What is taxable value? Taxable value is equal to amount of fees paid by employer minus amount recovered from employee. If education facility is provided in an educational institution owned and maintained by employer, what do you mean by this? You know, railway school, Indian Railways have various, many schools, okay, on its own. So Indian Railways is providing free education to railway employees children who are studying in railway schools. That means in railway schools, whoever the railway employees children are there, for them free education is given or nominal amount will be charged. That means in this case, for a railway employee, who is employer? Indian Railways is employer. Indian Railways is providing free educational facility or concessional education facility to employee children in railway school. That means railway school is the school owned by the employer. So if any educational facility is provided in educational institution that is owned by the employer, in such a case the benefit is taxable only for specified employees. Are you able to understand? This benefit is taxable only for specified employees. Do you know army schools? Who will study in army schools? Those army employees children will study in army school. Okay, they will be given free education facility or concessional education facility. In that case, employer is providing education facility to employee children in a school owned by the employer. So whenever education facility is provided in employer's own educational institution, in that case benefit is taxable only for specified employees. Okay, now how to tax the benefit. See, obviously benefit is received, right? Railway employee child is there. If railway employee joins him in a private school, he need to pay minimum 50,000 fees. Now, railway employee joined his children in railway school. Now he is not required to pay fees, or he is required to pay nominal fees of 5,000 rupees. Okay, that is benefit received by employee, right? How to calculate that benefit? If education facility is provided in employer's own educational institution, then if it is provided to children of employee, we have to see cost of education in the similar institution in the same locality. What do you mean by this? Let's say railway school is there in Vijayawada. We have to find another school beside railway school or in that locality which is providing same facilities. Okay, let's say railway school is there. Railway school is air conditioned. AC is there in railway school, for example. So in that same locality, if there is any school with the same AC facility and the same amenities just like as railway school, we have to check what is the cost of education in the similar school. If cost of education in the similar institution is less than or equal to 1000 rupees, then that benefit is not taxable. If cost of education is greater than 1000 rupees, then two alternatives are available. Either it is fully taxable or excess is taxable. Cost of education minus 1000 rupees per month. I will tell example. Beside railway school, Sri Chaitanya school is there. Okay, Sri Chaitanya school is also having same facilities and amenities just like as railway school. In Sri Chaitanya school, the cost of education is 800 rupees per month. In this case, benefit is not taxable. Benefit is not at all taxable. Second case, cost of education is 1400 rupees per month. Now, two alternatives are there. Either 1400 is fully taxable or 400 is taxable. Are you able to understand? 1400 minus 1000 rupees per month, 400 is taxable. Please remember, education facility provided in employer own educational institution, only if it is provided to children of employee, then only 1000 rupees benefit is available. If it is provided to other family members, 1000 rupees benefit is not available. Only if education facility is provided to children of employee, then only 1000 rupees exemption is available. If education facility is provided to other family members of employee, then whatever the cost of education in similar institution is there, that amount is fully taxable. 1000 rupees exemption is not available. So you can write here, for provided to family members of employee, 1000 rupees exemption is not available. Is it clear? Good. Now, see, sometimes training will be given to employees. If any training is given to employees, you can see even in banks also, for senior managers, training sessions will be conducted. 1 week workshop, training session, 10 days workshop. Okay, like all bank managers will be called to Mumbai. In Mumbai, training sessions will be conducted. In those training sessions, accommodation and food will also be taken care by the employer only. Now, if any amount is spent for training of employees, including stay and food, that amount is benefit received by employee, but that benefit is not taxable. The reason is employer is giving training to the employee for the purpose of employment. That's why if any benefit is received by employee as part of the training, that benefit is not taxable. And this exemption is available to any number of children. Employee has 4 children. For 4 children, free education is provided by employer in his own educational institution. Now for 4 children, if cost of education in similar educational institution is less than 1000 rupees, for 4 children the benefit is not taxable. Are you able to understand? Here many students gets confused. Education allowance is different, education facility is different. In case of education allowance, lump sum amount is given. In case of education facility, actual fees is paid by employer, or education facility is provided by employer in his own educational institution. So please understand the difference. Education allowance is different, education facility is also different. For education allowance, exemption is 100 rupees per month up to a maximum of 2 children. For education allowance, limit is there only for 2 children. For education facility, there is no limit. Any number of children can get benefit out of education facility. If any amount is recovered from employee, it shall be reduced from taxable. Now let us discuss medical facility. See, employer can provide medical facility to either employee or family members of employee. In certain cases, medical facility is not taxable, medical facility is exempt. What are those cases? Let us see. If medical facility is provided in a hospital maintained by employer, owned or maintained by employer, the employee is suffering from certain disease. Employer has his own hospital. In a hospital owned by employer, medical treatment was given to employee at free of cost. Now this is benefit received by employee, right? That benefit is not taxable, that benefit is exempt. For example, let's say uh, Mukesh Ambani is there. Not Mukesh Ambani. Let's say army hospitals are there. Now, army soldiers family has one particular type of disease. For that disease, treatment is given in army hospital at free of cost. Now, the same soldier, if he visits private hospital, he need to pay lot of medical bills. As he visited army hospital, his employer's own hospital, treatment was done at free of cost. Now, benefit is received by that soldier, right? Who is employee of Indian Army. Now, that benefit received by soldier is not taxable, it is fully exempt. So, simply if medical facility is provided in a hospital owned or maintained by the employer, then whatever the medical facility benefit received by employee is there, it is not taxable, it is fully exempt. Next, second case, reimbursement of medical expenses incurred in a government hospital or any other hospital approved by government. Now, employee has teeth problem. Employee went to government dental hospital. He got a treatment done. He purchased medicines and he paid certain expenses. Whatever the medicine expenses and medical expenses are there, these are reimbursed by employer. Now, expenses were reimbursed by employer. So, benefit is received by employee. But that benefit is not taxable because whatever the expenses that are reimbursed are there, those expenses are incurred in government hospital. So, if reimbursement of expenses in government hospital by the employer, that benefit is not taxable to the employee, that benefit is fully exempt. Next, reimbursement of medical expenses incurred in respect of specified disease in a hospital approved by Principal Chief Commissioner or Chief Commissioner. See, under Income Tax Act also, hierarchy, there are Principal Chief Commissioner and Chief Commissioner. So, every year, Principal Chief Commissioner and Chief Commissioner will notify certain hospitals. In those hospitals, if treatment is received for specified diseases and medical bills of such treatment is reimbursed by employer, that benefit is not taxable. Let's say Sunrise Hospitals is approved hospital by Chief Commissioner for the purpose of treatment of cancer. Employee went to Sunrise Hospitals, he got his cancer treatment done. Whatever the bills for cancer treatment are there, they are paid by employer. Whenever cancer bills 5 lakh rupees paid by employer is there, it is benefit received by employee. But those medical bills where they are paid in a hospital approved by Chief Commissioner. Now, in those hospitals, if any medical benefit is received, that benefit is not taxable. So, whatever the reimbursement of medical expenses by employer is there in a hospital approved by Chief Commissioner for treatment of specified diseases, in that hospital, whatever the medical benefit received by employee is there, that benefit is not taxable. Next, incurred for treatment of any illness relating to COVID-19. See, employee wife got COVID. She was admitted into hospital. Whatever the COVID bills are there, all COVID bills are paid by employer. Now, benefit is received by employee, right? But that benefit is not taxable to the employee. That benefit is fully exempt. So, if employer reimburses any medical expenses with regard to COVID-19 illness of either employee or his family members, whatever the medical expenses that are reimbursed are there, those medical expenses benefit is not taxable to the employee. But this is subject to three conditions satisfaction of. What are those three conditions? COVID-19 positive report. So COVID-19 positive report is required to be submitted, and the day on which COVID-19 was declared for that patient, from the date onwards for the next 6 months, whatever the medical diagnosis documents are there, okay, COVID-19 treatment related documents, those documents are required to be submitted, and COVID-19 medical expense certificate from the doctor. See, once you take treatment in a hospital, hospital will give the certificate, so and so person paid so and so amount for the purpose of treatment of COVID-19. That medical expenditure certificate is also required to be submitted. Sir, why it is required to be submitted? It is a evidence. It is a evidence that actually this much of expenditure was spent for COVID-19 medical expenses. Are you able to understand? So, like, reimbursement of medical expenses for treatment of COVID-19 is not taxable to the employee, but three conditions are required to be satisfied. COVID-19 report is required to be submitted. Medical diagnosis documents within 6 months. Whatever the medical diagnosis documents are there, they are required to be submitted. COVID-19 medical expenditure certificate is also required to be submitted. If all these three conditions are satisfied, then benefit received for treatment of COVID-19 is not taxable to the employee. Next, medical insurance premium, health insurance premium approved by IRDA. See, insurance premium paid by employer to the employee. That insurance premium is not taxable to the employee. When I use it to work in Infosys, up to 5 lakh rupees, I have cover. That means if something happens to me, up to 5 lakh rupees medical expenses will be taken care by Infosys. Do you really think Infosys pays 5 lakh rupees? No, Infosys will not pay 5 lakh rupees. What Infosys do? Infosys will pay insurance premium on my name. So whatever the insurance premium paid by Infosys on my name is there, okay, let's say Infosys paid 30,000 rupees insurance premium. That is benefit received by me. Why? Because if I apply separately for insurance premium, from my pocket I need to pay 30,000 rupees. But here who paid the insurance premium? Infosys paid insurance premium. So that 30 rupees is benefit received by me, but that benefit is not taxable. So if employer pays medical insurance premium of employees or health insurance premium of employees, that benefit received by employee is not taxable, provided whatever the insurance policy that is taken by employer is there, it should be approved by IRDA, Insurance Regulatory and Development Authority. Okay. Next, premium paid on personal accident insurance policies on the life of employees. See, generally transport companies, okay, for the life of drivers and cleaners, they will take personal accident policy. They will be daily driving in trucks, right? So chances of accident is there, so they will take personal life policy, okay, sorry, personal accident policy. So for personal accident policy also, if any premium is paid by employer, that premium is not taxable to the employee. In other cases means what? In a private hospital, employee took the treatment, that hospital bills are paid by employer. Now this benefit is received by employee, but that benefit is not exempt, that benefit is fully taxable. Employee got heart stroke, he went to the doctor and he got open heart surgery done with a family doctor, not in government hospital, okay, with the family doctor. Now for open heart surgery he charged 8 lakh rupees. Total 8 lakh rupees is paid by employer. It is benefit received by employee. That benefit is fully taxable to the employee, because medical facility is provided in a hospital other than government hospital and other than hospital owned by employer. That means in a private hospital or with family doctor, if any medical facility is received, and for such medical facility if bills are paid by employer, that benefit is fully taxable to the employee. If medical facility is provided outside India, see, there are some types of cancer for which you can find a treatment only outside India, okay, or there will be certain types of diseases which are cured exclusively outside India. So if any medical treatment is received outside India, majorly there are three expenses that can be incurred. First, patient has to be taken outside the country. For that, travel expenses will be there. During the period of medical treatment, they have to stay outside India, okay, they have to live in a room or live in a place. So for that, stay expenses will be there, and for the treatment, medical expenses will be there. So whenever medical treatment is provided outside India, three type of expenses will be there, like first, travel expenses, stay expenses, and medical expenses. Okay, medical expenses and stay expenses, they are exempt up to amount permitted by RBI. Balance is taxable. Whatever the balance is there, that balance will be taxable. RBI permitted 3 lakh rupees for medical treatment. Actual medical treatment is 3 lakh 70,000 rupees. Employer reimbursed 3 lakh 70,000 rupees. Now 3 lakh 70,000 rupees is benefit received by employee. Out of 3 lakh 70,000 rupees, 3 lakhs is exempt, 70,000 is taxable. Because RBI permitted only 3 lakhs. Up to the amount permitted by RBI, whatever the medical expenses facility received is there, that is exempt, balance is taxable. Are you able to understand? So for medical treatment and stay expenditure, whatever the amount permitted by RBI is there, that is exempt, balance is taxable. Next, for traveling expenses. Here another thing, along with patient, one attendant also go. For patient and one attendant, if any benefit is given, that benefit is not taxable and it is exempt up to the amounts permitted by RBI, beyond is taxable. Now, along with patient, two attendants went. That means patient is employee, employee wife and employee son also went. That means along with patient, two extra persons went. Only for one person the exemption is available, for another attendant exemption is not available, it is taxable. Are you able to understand? So let's say stay expenditure per day is $300. Out of $300, for patient and one attendant, $200 is only exempt, balance $100 is taxable. That means medical treatment facility exemption is available only for, stay expenditure benefit exemption is available only for patient and one attendant. Other than one attendant, if second attendant goes, means for second attendant, whatever the stay expenditure incurred is there, which is reimbursed by employer is there, that is fully taxable. Next, traveling expenses. Listen carefully. Traveling expenses reimbursed by employer. That means, let's say employee went to United Kingdom, UK, London. So to go to London, flight expenses will be there, right? Traveling expenses. Those travel expenses also reimbursed by employer. Now it is benefit received by employee. But that benefit is taxable only if gross total income is less than or equal to 2 lakhs. So if gross total income is less than or equal to 2 lakhs, then traveling expenditure benefit is not taxable. If gross total income is greater than 2 lakhs, then traveling expenditure benefit is taxable. I will explain one example through which you will understand better. For example, medical expenses, stay expenses, travel expenses, actual expenditure permitted by RBI. Taxable. Now, gross total income of employee is 1,85,000. How much? 1,85,000. Actual medical expenses are 70,000. Amount permitted by RBI is 64,000. To the extent of amount permitted by RBI, it is exempt, right? So how much is exempt? Out of 70,000, 64,000 is exempt and balance 6,000 is taxable. Stay expenditure. Actual stay expenditure is 30,000. But for the purpose of stay, amount permitted by RBI is only 22,500. So how much is taxable? 7,500 is taxable. Correct? So medical expenditure, stay expenditure, to the extent amount permitted by RBI, it is exempt, balance it is taxable. In examination also, no confusion. He will give amount permitted by RBI, to that extent you will exempt it, balance you will tax it. Are you able to understand? Next, travel expenses. Let's say travel expenses are 15,000. What I said, in order to tell whether travel expenses are taxable or not, what you need to check? You have to check gross total income. Gross total income including medical expenditure benefit and stay expenditure benefit. How much is medical expenditure benefit? 6,000. Stay expenditure benefit 7,500. So 1,85,000 plus 6,000 plus 7,500. How much? 1,98,500. It is less than 2 lakhs, right? So this travel expenditure benefit is not taxable. Are you able to understand? I will make another change. For example, here gross total income is, let's say, 1,90,000. Now how much is benefit received? Now how much is gross total income? 1,90,000 plus 6,000 plus 7,500. 2,03,500. In this case, gross total income is greater than 2 lakhs. Now this travel expenditure benefit is also, are you able to understand? Many people, they will consider only gross total income. No, you should not consider only gross total income. Along with gross total income, you have also consider medical expenditure benefit. You also have to consider stay expenditure benefit. So gross total income plus medical expenditure benefit plus stay expenditure benefit. If all these three together, if it is greater than 2 lakhs, then medical benefit is uh, like taxable. Travel expenditure benefit is taxable. Otherwise, travel expenditure benefit is exempt. Medical allowance, that means if any lump sum amount is given for treatment, every month to employee 20,000 rupees is given for medical expenses, lump sum amount. This is medical allowance that is fully taxable. I told family members, medical facility can be given to employee or his family members. Sir, who are family members? Family members can be either spouse, any children. That means whether children are dependent or independent, whether children are married or unmarried, that is not relevant. If medical facility is given to children, then that benefit is then that benefit is exempt, subject to if facility is given in government hospital or hospitals approved by government. So for this purpose, medical facility family means spouse. Children can be any children, dependent or independent, married or unmarried, dependent parents, dependent brothers and sisters. That means for independent parents, if any medical facility is given, that benefit is not exempt. For example, my daddy is earning money, I am also earning money by working in a company. Medical expenses of my father reimbursed by my employer. Now, my father is not dependent on me. For independent, my father is independent of him. Now, whatever the medical expenses that are reimbursed, it is benefit received by me. That benefit is fully taxable. Are you able to understand? Because he is not covered under definition of family. Only dependent parents are covered. So this is all about medical facility. I explained very clearly. Hope this will be useful. Now, let us discuss car facility. There are three parameters. Using these three parameters, we are going to calculate the taxable value of car perquisite. First parameter is who is owner of car. Second parameter is who pays expenses of car. Third parameter is usage of car. So the car is owned by employer or employee. That is first question. Second question, whether expenses of car are paid by employer or employee. That is second question. Third question is for which purpose car is used. Is it used for official purpose, or is it used for personal purpose, or is it used for both purposes? These three questions are there. Based on these three questions or parameters, we are going to arrive at the calculation of taxable value of car perquisite. Shall we go ahead? So, car. First question, who is the owner of the car? If car is owned by employer, one tax treatment is there. If car is owned by employee, another tax treatment is there. Next, if car is owned by employer and expenses also paid by employer, there is another calculation. If expenses are paid by employee, then another calculation is. Car is owned by employee, expenses are paid by employer. There is another calculation, and expenses are paid by employee. Next, car is owned by employer, expenses also paid by employer, and car is used for office purpose, personal purpose, both purposes. Car is owned by employer, expenses paid by employee, and car is used for office purpose, personal purpose, both purposes. Car is owned by employee, expenses are paid by employer, and car is used for office purpose, personal purpose, both purpose. Car is owned by employee, expenses paid by employee, and car is used for office purpose, personal purpose, both purpose. That means in total, how many cases are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So out of 12 cases, if car is owned by employee and expenses also paid by employee, let's say I am working in Infosys. I purchased a car. For car, maintenance expenses also paid by me, fuel expenses, repair expenses. And I am using car for office purpose, I am using car for personal purpose, or I am using car for both purposes. See, is there any benefit received by me? No, there is no benefit received by me. Why? Because employer is not paying anything. Employer is paying certain expenses and I am using car for personal purpose. Then there is benefit received by me. But here car belongs to me, expenses paid by me, and car is used by me for office purpose or personal purpose or both purposes. No benefit is received from employer. So in this case, whether it is used for personal purpose or office purpose or both purposes, in these three cases, it is not taxable. Why is it not taxable? Because no personal benefit is received from employer. Employer did not purchase the car. Employer did not pay expenses. Then is there any personal benefit received by me? No, as there is no personal benefit received by me, it is not. First case, car is owned by employer, expenses are paid by employer, and car is used for office purpose. Tell me one thing. I joined in Infosys. Infosys purchased car. Infosys is paying fuel expenses. Infosys is paying repair expenses, and I am using that car for Infosys business meetings. Did I use it for my personal purpose? No. If I do not use it for personal purpose, did I get any personal benefit? I did not get any personal benefit. As I did not get any personal benefit, whenever car is used for office purpose, not taxable. So any case, so in all these cases, whenever car is used for office purpose, it is not taxable. The reason is no personal benefit is received by employee. Are you able to understand? So out of 12 cases, 6 cases are sorted out. 3 cases, car owned by employee, expenses paid by employee, no personal benefit received. So in those 3 cases, not taxable. In remaining 9 cases, whenever car is used for office purpose, there is no personal benefit received. That's why it is not taxable. Car is owned by employer and expenses are paid by employer. Car is used for personal purpose. Infosys purchased car. Infosys is paying fuel expenses and repairs expenses. I am using that car for my family tours. In that car, quite often I am going on family tours. That means completely that car is used by me for my personal purpose. There is benefit received by me because I am using that car for my personal purpose. In this case, taxable value is equal to 10% of cost of car plus actual expenses paid by Infosys plus driver salary. See, if driver is also provided for that car, whatever the driver salary that Infosys is paying, see, driver is spending time for me for my personal purpose. So whatever the salary paid to driver by Infosys is there, even that is also benefit received by me. Are you able to understand? Car is owned by employer, expenses are paid by employee, and car is used for personal purpose. See, Infosys purchased car. And fuel expenses are borne by me. I am using that car for my personal purpose. See, there is personal benefit received by me because car do not belong to me, car belongs to Infosys. The taxable value of benefit to me is equal to 10% of cost of car. Next, car is owned by employee, expenses are paid by employer. I purchased a car, but Infosys is paying petrol bills. Infosys is paying service bills. I'm using that car for my personal purpose. There is personal benefit received by me because maintenance expenses are paid by Infosys. So in this case, taxable value is equal to actual expenses paid by employer plus driver salary. Car is owned by employer. Expenses are paid by employer. Car is used for both purposes. That means what? Infosys purchased the car. Infosys is paying all the expenses of the car, and I am using that car for my office purpose as well as for personal purpose. You can see here, car owned by employer, expenses also paid by employer, and car is used for both purposes. In this case, we have to check the cubic capacity of the car. If cubic capacity of the car is less than or equal to 1.6 liters, okay, then taxable value is equal to 1800 per month. If cubic capacity of the car is greater than 1.6 liters, then taxable value is equal to 2400 per month. Okay, so we have to see the CC. 1600 cc. If the cubic capacity of the car is less than or equal to 1600 cc, it is small car. For small car, taxable value of perquisite is equal to 1800 per month. For big car greater than 1600 cc, taxable value of perquisite is equal to 2400 per month. If driver is also provided, means additionally we will also add 900 per month. Are you able to understand? Next, car is owned by employer. Expenses are paid by employee. Car is owned by employer and expenses are paid by employee, and car is used for both purposes. Infosys purchased car. I am paying all the expenses and I am using the car for my personal purpose as well as for office purpose. Now, if it is small car, taxable value is equal to 600 per month. If it is big car, taxable value is equal to 900 per month. If driver is also provided, means along with 600 per month or 900 per month, additionally you also have to add 900 per month if driver is provided by the employer. Next, car is owned by employee, expenses are paid by employer, and car is used for both purposes. What is this? I purchased the car. I purchased Mercedes Benz car. For that Benz car, Infosys is paying all the expenses. And how I am using that car? I am using that car for my office purpose as well as for personal purpose. So, car purchased by me, expenses paid by employer, usage of car is for both purposes. Now, in this case, first what we need to consider is, we have to consider cubic capacity of the car. Actually, I am doing re-recording of the lecture. That's why old content is there. So, let's say car is owned by me. Expenses are paid by ITC Limited. Let's say employer is ITC Limited. And car is used for both purposes. Car cubic capacity is 3000 cc. That means it is a big car. First, you have to take expenses paid by employer. Let's say employer paid for that Mercedes Benz car in 1 year. Expenses are 1,50,000. You can see here expenses met by employer. From that you need to reduce office purpose expenses. If it is small car, you have to reduce 1800 per month. If it is big car, you have to reduce 2400 per month. Okay, if driver is also provided, means you have to reduce 900 per month. So car belongs to me, expenses are paid by ITC Limited, and car is used for both purposes. How much expenditure is spent by ITC Limited? 1,50,000 rupees. Now for office purpose, how much I will reduce? I will reduce to 2400 per month. Why? Because it is a big car. 2400 into 12, how much? 28,800, correct? So how much is taxable value? 1,21,200 is taxable value, correct? Here I will raise one question. Now I am telling you, sir, even though I used car for office purpose and personal purpose, both purposes, 90% of the time I used car for office purpose only. Hardly 10% of the time I used car for personal purpose. That means what? Out of this 1,50,000, 1.4 lakh was spent for office purpose. Hardly 10,000 was spent for personal purpose. Sir, but you are taxing me. That means I used only 10,000 for my personal purpose. Employer money, 10,000 is used for my personal purpose. But here, as per Income Tax Act, 1,21,200 is being taxable value to me. Now this is unfair, right? Hardly I used 10,000 rupees of their money and I am asked to pay tax on 1,21,200. This is very unfair, right? So for this purpose, what Income Tax Act said is, apart from this 28,000, if any extra expense, that means what? If I want to claim 1,40,000 here, I can claim extra expense and only 10,000 is taxable to me, but subject to satisfaction of two conditions. Are you able to understand? Generally, for office purpose, if it is small car, 800 per month expenditure is allowed for office purpose. If it is big car, 2,400 per month is allowed as expenditure. If I want to claim extra expenditure, can I claim? Yes, I can claim, but subject to satisfaction of two conditions. If two conditions are satisfied, I can claim 1,40,000 as deduction and taxable value to me is 10,000 rupees. So to claim extra expenditure for office purpose, two conditions are required to be satisfied. What are those two conditions? Employer has maintained complete details of journey undertaken for official purpose, which may include date of journey, destination, mileage, amount of expenditure incurred thereon. So in this case, if I want to claim extra expenditure over and above 1,800 or 2,400 per month, employer has to maintain proper details for that car. Okay, like employer has to maintain details for office purpose. When the car went for office purpose, what is the date of journey, what is the mileage, what is the date of destination, how many kilometers traveled, what is the amount of petrol that is consumed, okay, what is the expenditure that is incurred there on. All these details which are incurred for office purpose, they are to be properly maintained by the employer, and employer has to give the certificate that whatever 1,40,000 or extra expenditure above 1,800 or 2,400 is there, that extra expenditure is incurred only for official purpose. Okay, employer has to give that certificate. So complete details has to be maintained and certificate should be given by the employer for extra expenditure. So if these two conditions are satisfied, extra expenditure can be claimed. Are you able to understand? So whenever car is used for office purpose and whenever more than 1,800 or 2,400 per month expenditure is required to be claimed, two conditions are required to be satisfied. First condition is maintenance of complete documents. Second condition is certificate is required to be given by the employer. So we have completed 12 cases, right? When two or more cars are given, when two or more cars are provided. Let's say I am CEO of a big company, for example. Employer gave me three cars, Mercedes, BMW, Audi. Three cars are given to me. See, for office purpose, one car is sufficient, right? Why three cars are required for office purpose? That's why if more than one car is given, at the option of the employee, only one car is treated as case 3. That means what? One car is considered as car given by employer, expenses paid by employer, and car is used for both purposes. Remaining two cars are taxed under case 2. Case 2 means what? Car is given by employer, expenses paid by employer, and car is used for office purpose as well as for personal purpose. So if more than one car is given, at the option of the employee, any one car is taxed as case 3, used for both purposes. Remaining all cars are taxed as case 2, used for personal purpose. Are you able to understand? Where any automotive conveyance other than car. See, other than car, if any automotive conveyance is given, news reporters are there. News channels generally give bikes to news reporters. So these news reporters goes to various places. They will collect news and give the news to the news channel. Let's say bike is given by news channel to the news reporter. News reporter is exclusively using that bike for office purpose. Morning he is coming to office, taking bike, collecting news. Evening depositing the bike in office and he is going away. Completely using that bike for office purpose. In this case, taxable value is nil. Are you able to understand? Second, bike is used for both purposes. Morning time, news reporter is using bike for collection of news. Evening time, he is going on a ride with his friends. So bike is used for both purposes. In this case, we have to consider expenses met by employer. Let's say for that car, every month 2000 rupees petrol expenditure is incurred by employer. Out of 2000 rupees, 900 per month is considered as office purpose expenditure. Balance 1100 is considered as personal purpose, and that benefit is taxable. Are you able to understand? Next. Car facility is exempt in following cases. Whenever car facility is given for traveling between office and home or home and office, that cab facility is not taxable. That cab facility is completely exempt. Generally, for software employees, software companies give a cab facility. Okay, a car facility to come from home to office or office to home. That car facility is totally exempt. Next, for Supreme Court judges and High Court judges, if any car facility is given, that car facility is not taxable. That car facility is exempt only if they are paying taxes under optional tax rates. If they are paying tax under default tax rates, again car perquisites. So this is all about car perquisite. Next, let us discuss about interest-free loan. See, if loan is given to the employee at a reduced rate of interest, that is also benefit received by employee, right? Generally, in outside market, if I take a loan, people are charging 18% interest. I took loan from employer. Employer asked me to pay only 7% interest. Outside, I am required to pay 18% interest. With employer, I am required to pay only 7% interest, which is beneficial. Obviously, paying interest to employer is beneficial because I am required to pay only 7%. So the difference of 18 minus 7, 11% benefit is there to me. Whatever that 11% benefit is there, that benefit is taxable to me as a perquisite. Why employer is giving that loan at very low rate of 7%? Because I am working with him. So whatever the benefit is there, that benefit is taxable to me as a perquisite. But interest-free loan is exempt in following cases. If the amount of loan is petty, it is less than or equal to 20,000, then that benefit is not taxable. Let's say I took 15,000 rupees loan from employer. On that 15,000 rupees, employer is not taking any interest. Even though he is not taking any interest, still no benefit is taxable to me. The reason is the amount of loan is less than 20,000. If the amount of loan is greater than 20,000, then we have to calculate interest-free benefit, and that benefit is taxable as a perquisite. So loan was taken for the purpose of treatment of specified diseases. See, we will study in chapter 6 reductions, specified diseases, for example, cancer. So for treatment of specified diseases, if any loan is taken from employer, then on such loan, whatever the interest rate benefit is there, that is not taxable, even though loan is greater than 20,000. Even loan amount is greater than 20,000. Let's say employee is suffering with cancer. He took 4 lakhs loan from employer. Employer is not charging any interest. If 4 lakhs is borrowed from outside, means he is required to pay 18% interest. So how much benefit is there to me? 18% interest rate benefit is there to me. That is not taxable because loan is taken for treatment of specified disease. Are you able to understand? Even though loan amount is greater than 20,000, still if loan is taken for treatment of specified disease, interest rate benefit is not at all. It is taxable in other cases. So market rate, what is market interest rate? For this purpose, market interest rate means rate charged by SBI as on first day of the relevant previous year on monthly, like maximum outstanding monthly balance minus interest actually paid by employee. So market interest rate means we have to go to SBI website on 1st April, whatever the interest rate is there, that we have to take as 1st April of the previous year. We have to take as market interest rate. From that, we have to reduce interest rate charged by employer. So we will arrive at interest rate benefit. So interest rate benefit is equal to rate charged by SBI minus interest actually paid by employee. Maximum outstanding monthly balance. To understand this concept, let us solve one problem so you will get clarity. Following benefits have been granted by Global Software Limited to one of its employees, Mr. Babu. Housing loan at the rate of 6% per annum. Amount outstanding as on 1st April 24 is 6 lakhs. Mr. Babu pays 12-month 12,000 per month towards principal on 5th of each month. So what is the amount of repayment that is done every month? 15,000 rupees. The lending rate of SBI as on 1st April 24 for housing loan may be taken as 10%. So how much is interest rate benefit? Interest rate benefit is equal to SBI interest rate 10% minus interest charged by employer or interest paid by employee. How much? 6%. So interest rate benefit is equal to 4%. Correct? See, at the end of April, outstanding balance is 5,88,000. Why? Actually, 6 lakhs loan is there. Out of 6 lakhs, how much is repaid? 12,000 is repaid. So, outstanding balance is 5,88,000. So, interest will be 5,88,000 into 4% into 1 by 12, because for 1 month only we are calculating. For next month, outstanding balance is changing. So that's why maximum outstanding monthly balance means every month whatever the outstanding balance is there, on that we are going to calculate interest rate benefit. Are you able to understand? So 5,88,000 into 4% divided by 12, it is 1960. Second year, 5,88,000 minus 12,000. How much? 5,76,000. 5,76,000 into 4% into 1 by 12. How much? 5,76,000 into 4% divided by 12. It is 1920. So likewise, you calculate, it will be 1880. Next, it will be 1840. Next, it will be 1800. It will be 1760. If you want, you can calculate. It will be 1720. It will be 1680, 1640, 1600, 1520. How much is interest rate benefit that is taxable? 1520 plus 1560 plus 40 plus 60 plus 1720 plus 1760 plus 18 plus 18 plus 1920 plus 9. Interest rate benefit is 20,008. Now, did you understand how to calculate interest rate benefit? So you have to consider every month whatever the outstanding monthly balance, on that you have to apply interest rate benefit divided by. Second point, this is this you will come to know only if we have discussed other sources. Oh, this point will be taught only in regular class. It will not be taught in booster series because it consumes time. It's not because I cannot explain. I need at least 15 minutes of time to explain. Next, movable assets. See, movable assets can be given to the employee for usage purpose, or they can be directly sold to the employee. I'm working in Infosys. I want refrigerator in my home. Infosys has refrigerator in its canteen. Now, I can ask Infosys to give refrigerator to me for my usage purpose. I will use it for 1 or 2 years, then I will return it back. That is case 1. Case 2, I can ask Infosys to sell that refrigerator to me. Okay, that is case 2. First, let us discuss case 1. Whenever movable assets are given for usage purpose to the employee, then if laptop and computer are given to the employee for usage purpose, even though they are given for personal usage, still taxable value is nil. Are you able to understand? See, laptop is given to me for office work. There is no personal benefit received by me. It is not taxable. Laptop is given to me for the purpose of gaming, for the purpose of watching movies. Okay, for my personal purpose. Then that benefit is, even though it is given for personal purpose, it is not taxable. Remaining assets, if they are given for usage purpose, then if those assets are owned by employer, taxable value is equal to 10% per annum of actual cost of the asset. If those assets are hired by employer, taxable value is equal to actual rent paid or payable by employer. Are you able to understand? Transfer of assets. See, whenever asset is transferred by employer to employee, we have to calculate completed years. For completed years, we have to reduce the depreciation, and only on balance amount Okay, from balance amount, we have to reduce the sale value. Thereby, we will calculate the perquisite. Once we reduce depreciation, we will arrive at written down value. From that written down value, we have to reduce amount recovered from employee. So that's how we are going to calculate. The calculation part I will explain through an example, so we will get complete clarity. But depreciation rates are different. Please be careful, listen very carefully. Under PGBP, for calculation of depreciation, separate depreciation rates are there. Under the head salaries, for calculation of movable assets perquisite, separate depreciation rates are there. Don't get confused. When you are doing perquisite calculation, you have to apply these depreciation rates. When you are calculating depreciation under PGBP, you have to apply those depreciation rates. Okay. So, see, for this perquisite, if whatever the asset that is transferred, if asset transferred is laptop, computer and electronic gadget, rate of depreciation is 50% under written down value method. Under PGBP it is 40%, for perquisite it is 50%. For car, rate of depreciation 20% written down value method. For other assets, rate of depreciation 10% SLM method. See, let us see this example. The employer sells the following assets to employee on January 1st, 2025. When asset was sold January 1, 2025. Cost of asset to the employer 6,96,000. Date of purchase May 15, 2022. Sale price 2,10,000. So when it is purchased 15th May 22, when it is transferred 1st January 25. So how many completed years are there? You know completed years, right? We will ignore part of the year. Only completed years we will take. 15th May 22 to 15th May 23 1 year. 15th May 24 2 years. 15th May 25 third year. But it was not held up to 15th May 25. It was sold on 1st January only. So completed years are 2 years. And what is the asset? Asset is car. So for car, the rate of depreciation is 20%. Correct. So how much is value of the car? Cost of car is 6,96,000. We have to reduce depreciation for 2 years. Less. What is the rate of depreciation? 20% written down value method. Correct. Depreciation at the rate of 20%. 139, 200. 5,56,800. Second year less. Depreciation at the rate of 20. 556,800 into percent. 1,11,000. 4,45,440. So this is written down value, right? So the value of asset is 4,45,440. At what price it is sold to the employee? It is sold to the employee only for 2,10,000 rupees less the sale price. See, 4,45,440 worth of asset is sold to employee for only 2,10,000 rupees. Now, how much is benefit received by employee? 2,35,440. Are you able to understand? Next, for computer, generally for computer, what is the rate of depreciation? 50% written down value method. Same, purchased on May 15, 22, sold on 1st January 25. How much is the value? Value is 1,17,000. So cost is 1,17,000. 2 completed years. Depreciation for first year, how much? Exactly 50%, right? Divided by 2. How much? 58,000. Balance 58,500. Depreciation for second year. Exactly half. 29,250. So written down value 29,250. How much is benefit received? Benefit received is 24,270. Sorry. Sale price is 24,270. How much is benefit received? Benefit received is equal to 4980. Next, fridge. Fridge rate of depreciation is 10%. Method is straight line method. So how many years? 2 years, right? Cost is 40,000. For straight line method, depreciation every year is same, right? Less depreciation 40,000 into 10% into 2 years. How much? 8,000. How much is benefit received? Sorry, not benefit received. Written down value. Written down value 32,000. It was sold for sale value how much? 1,000 rupees, right? Sale value 1,000. So benefit received is equal to 31,000. X is given a laptop by the employer for using it for office and private purpose. I told you, whenever laptop is given, even though for personal purpose, benefit is not taxable. Taxable value will be 0. On 15th October 23, company gives its music system to Y for domestic use. Listen carefully. Is it sold? Whether music system is sold? No. Music system is given only for usage purpose, domestic usage. So, what is the benefit? Benefit is equal to 15,000 into 10% rate of, whenever it is given, it is owned by company, right? So taxable value is equal to 10%. When it was given 15th October, that means it was given for 5.5 months. In the middle of the month, October, it was given into 5.5 by 12 months. How much? 687 point. Is it clear? Next, gift. See, cash gift is given. It is fully taxable to the employee. Okay, no exemption for cash gift. But gift is given in the form of kind. Whenever gift is given in the form of kind, we have to check the value of the gift. If value of gift is less than 5,000, then it is not taxable. If aggregate value of gifts received is greater than 5,000, then two alternatives are there. Either excess of 5,000 is taxable or fully taxable. So out of these two, anyone is taxable. Employer gave cash gift, fully taxable. Employer gave watch. If value of watch is less than 5,000 and it is the only gift, not taxable. Value of watch is more than 5,000. Two alternatives are there. Either, let's say value of the watch is 8,000 rupees. Either total 8,000 is taxable or 8,000 minus 5,000, 3,000 is free or concessional food and non-alcoholic beverages. See, in office, if tea and snacks are provided, okay, it is basic courtesy, right? Once you go to office, tea or coffee will be given. So, basic courtesy, tea and snacks, if they are given, that is also benefit received by employee, but that benefit is not taxable. Other than tea and snacks, if lunch, dinner, okay, main menu is provided, then if it is provided during working hours, including overtime working hours or on holidays in a remote area, in rent-free accommodation, we have discussed about remote area. So if free food and non-alcoholic beverages are provided in remote area, then that benefit is not taxable. If free food and non-alcoholic beverages are provided during working hours, including overtime or on holidays at office or business premises, then we have to check if the value of the food is less than 50 rupees, then exempt. Completely exempt. If value of food is more than 50 rupees, then up to 50 rupees it is exempt, excess is taxable. Let's say value of lunch is 40 rupees, it is not taxable. Value of lunch is 60 rupees, up to 50 rupees exempt, balance 10 rupees is taxable. In some of the MNC companies, they will give vouchers. Okay, using these vouchers, you can eat food in the canteen. So if vouchers are given, then you have to consider value of the voucher, value of the meal. If the value of the meal is greater than 50 rupees, up to 50 rupees only exempt, more than 50 rupees it is taxable, excess is taxable. But if vouchers are given, 50 rupees exemption is available only if SSC is paying taxes under optional tax. Sweat equity shares, specified securities. See, if sweat equity shares are given to the employee, then you all know sweat equity shares are given at a concessional price than market price. For example, market price is 90 rupees. Sweat equity shares will be given for only 40 rupees. Then how much is benefit received by employee? Benefit is equal to 90 minus 40. 50 rupees. This benefit is taxable as perquisite. Are you able to understand? So whenever an employee receives sweat equity shares, difference between market price and price paid by employee, that is to be considered as benefit received by employee, and that benefit is taxable as a perquisite. The important thing here is calculation of market price. You have to consider market price on the date of exercising the option. For example, Infosys gave me sweat equity shares. Infosys gave sweat equity shares offer on 1st February. I exercised option. That means it gave offer. I gave acceptance and I exercised on 5th February. Sweat equity shares are allotted on 9th February. On which date I have to consider the market price? I have to consider market price on the date of exercising the option. Are you able to understand? So what you need to consider is market price or on the date of exercising the option minus sweat equity shares purchase price of employee. These two differences is to be considered as benefit received by employee, and it is taxable as perquisite. See, market price 90 rupees, well and good. You have to consider market price on the date of exercise of the option. But how do we know market price, sir? If shares are already listed on a stock exchange, daily trading happens, right? So if shares are already listed on recognized stock exchange, then we have to consider average of opening price and closing price on the date of exercising the option. So at the beginning of the day, on first transaction, opening price will be there. On the last transaction, closing price will be there. You have to do average price. Opening price plus closing price divided by 2. You have to consider average price. Are you able to understand? So average price we will consider as fair market value. If shares are traded in more than one recognized stock exchange, let's say Infosys shares are there. They are traded on Bombay Stock Exchange. They are also traded on National Stock Exchange. Now, on the date of exercise of the option, whichever the stock exchange has done higher trading of that particular stocks, that stock exchange's average price you have to consider as fair market value. Let's say Infosys shares in Bombay Stock Exchange traded are 8,000. In National Stock Exchange traded are 9,000. Where Infosys shares are traded more, National Stock Exchange. So in National Stock Exchange, on the date of exercise of the option, whatever the average price is there, that average price is to be taken as fair market value. Are you able to understand? Listed but not traded in more one recognized stock exchange. What do you mean by this? Let's say date of exercise of option. Date of exercise of option is on Sunday. On Sunday, whether stock exchange is available, Sunday stock exchange is not available. On Saturday, whether stock exchange is available, on Saturday also stock exchange is not available. On Friday, whether stock exchange is available, yes, on Friday stock exchange is available. On Friday, whatever the closing price is there, that closing price we have to consider as fair market value. Are you able to understand? So listed the closing price of the share on any recognized stock exchange on a date closest to the date of exercising of the option and immediately preceding such date. Are you able to understand? Listed but not traded in more than one recognized stock exchange. What do you mean by this? Infosys shares are traded on Bombay Stock Exchange and National Stock Exchange, but date of exercise of option is exercised on Saturday. On Saturday, whether market is available? No. So you have to take Friday. On Friday, you have to consider in which stock exchange higher shares are traded. Let's say in Bombay Stock Exchange, 12,000 Infosys shares are traded. In National Stock Exchange, 9,000 Infosys shares are traded. Where highest trading happened? Bombay Stock Exchange, right? So in Bombay Stock Exchange on Friday, whatever the closing price is there, that closing price will be considered as fair market value. If shares are not listed on a recognized stock exchange, then like fair market value will be determined by merchant banker. So if unlisted shares are there, for unlisted shares, you have to arrive at fair market value based on the valuation given by the merchant banker. Traveling, touring, etc. See, generally in offices, employees gets vexed up. Whenever employees gets vexed up, employer provides, tour facility. So let's say tour facility is provided to employee. Now employee wants to go on a tour to Kulu and Manali. The tour cost for 5 days is 80,000 rupees. Total 80,000 rupees is paid by employer. Now this is benefit received by employee. If employee wants to go on his own means he need to personally spend 80,000. Now this 80,000 is paid by employer. This 80,000 is benefit received by employee and that benefit is taxable. So if traveling touring benefit is given to the employee, then whatever the expenditure paid by employer is there, that expenditure is taxable to the employee as perquisite. If facility is provided from own resources, Make My Trip is there, its business is providing tour facilities. Okay, Make My Trip to one of its employees gave tour facility on Make My Trip website only. That means employer is providing tour facility from his own resources. In that case, taxable value to the employee is equal to, if the same tour package is provided by another operator, whatever the taxable value is there, that is considered as taxable value. For example, Make My Trip gave one tour facility to its own employee to Goa trip for 4 days. Now, how much is benefit received by Make My Trip employee? If the same 4 days Goa tour facility is given by another operator, let's say he charges 60,000 rupees. That 60,000 rupees is the benefit received by Make My Trip employee. So if provided from own resources, taxable value is equal to value at which such facility is offered by other agencies to the public. If any amount is recovered, it should be reduced from taxable value. Where employee is on official tour and expenses incurred for any member of his household accompanying him. See, actually, employee went to Mumbai for meeting. Employee, family members also came. For family members also, traveling expenses are reimbursed by employer. Now it is benefit received by employee, right? For employee, he is going for office purpose, no personal benefit. But for family members, personal benefit is received. So whatever the traveling expenses of family members is there, that is taxable to the employee as perquisite. Are you able to understand? Where any official tour is extended as a vacation, expenses incurred for extended period shall be taxable. What do you mean by this? Let's say employee is there. Employee went to Delhi for attending board meeting for 3 days. So he attended board meeting for 3 days. 2 days he extra spent in Delhi. That means total 5 days he spent in Delhi. Balance 2 days he enjoyed in Delhi. He went to various spots in Delhi, enjoyed there. For 5 days, accommodation expenditure, traveling expenditure is borne by the employer. Out of 5 days, 3 days are for office purpose, no personal benefit received. But for 2 days, like employee spent for personal purpose, but expenses are paid by employer. There is personal benefit received by employee, that personal benefit is taxable. So for 2 days, whatever the expenses are there, those expenses are considered as benefit received by employee and it is taxable. Free or concessional tickets. See, airlines, railways, these two entities, if they provide free air travel facility or free railway travel facility to their employees or employees family members, that benefit is not taxable to them. So airways, railways, if they provide free travel facility to their own employees or employee family members in their own transportation, then that benefit is not taxable. If it is provided to employees working in railways or airlines, the benefit is not taxable. If transportation facility is provided to employees in any other transportation, for example, RTC, Road Transport Corporation, provided transport facility to its employees or employees' family members, then taxable value is equal to, if the same facility is provided to outsiders, how much ever the ticket price that is charged is there, that amount is considered as benefit received by employee. RTC, conductor is there. He along with his family members going to Tirupati for Balaji Darshan. Now, he is going in RTC bus. As he is the conductor working in RTC, like he has given free transportation facility. For 4 members, whatever, like 4 members went to Tirupati at free of cost. For these 4 members, if these 4 members are outsiders, whatever the ticket price that is charged is there, that amount is considered as tax benefit received by RTC conductor, and that amount is taxable to the RTC conductor as per club facility. See, if any club facility is provided, generally for, if club facility is given for all employees uniformly, then benefit received by employees is not taxable because that benefit is given for all employees uniformly. You can see here there would be no perquisite for use of health club, sports club and similar facilities provided uniformly to all employees. So whenever club facility is given to all employees uniformly, then that benefit is not taxable to the employee as perquisite. Are you able to understand? Next, where employer has obtained corporate membership of the club and facility is enjoyed by employee or any members of his household, the value of perquisite shall not include the initial fees paid for acquiring such corporate membership where benefit does not remain with a particular employee. What do you mean by this? Benefit does not remain with particular employee. That means benefit is given to all employees uniformly. See, very simple. Club facility, if it is given to all employees uniformly, that benefit is not at all taxable. If it is not given uniformly, let's say club facility is given only to elite cadre, managing director, CEO, okay, likewise, chief executive officer, operational officer, okay, see, financial officer, whoever are there in main cadre, only for them club facility is given. Then it is not given uniformly to all employees, right? Then club facility is taxable. So when club facility is not given uniformly, it is taxable. How much is the taxable value? See, to join club, initially membership fees is required to be paid. So whatever the membership fees paid by employer is there, that is benefit received by employee. Annual fees will be there. Every year, recurring fees is required to be paid to the club. So whatever the annual fees that is paid is there, that is also benefit received by employee. Any expenditure on club facility used by the employee or any member of his household. See, after going to club, if any expenditure is incurred by employee and if that expenditure is paid by employer, then also it is benefit received by employee and it is taxable as perquisite. So if club facility is not provided uniformly, then what is the taxable value? Initial membership fees paid by employer, that is taxed to the employer as perquisite. Every year whatever the renewal fees paid is there, that is also taxed to the employer as perquisite. Employee expenditure, employee club expenditure reimbursed or paid by employer, even that is also considered as benefit received by employee and it is taxable as perquisite. If club is used wholly and exclusively for business purpose, sir, how can a club can be used for business purpose? Club can also be used for business purpose. Cinema actors are there for Bahubali for 5 to 6 months. The duty, I mean, the job of the actors is to make their body get prepared for the movie. So, like cinema production house is there. It has taken club membership. Why it has taken club membership? So these actors will go to the gym and they will prepare their body for the next film. Now, why club access is taken? It is taken for the purpose of production of film. Next, leave travel concession. See, if employee goes on a leave to any place in India, whatever the travel expenses are there for employee and his family members, if those travel expenses are reimbursed by employer, then it is benefit received by employee, right? That benefit we call as leave encashment. The only thing here important is travel should be only within India. If travel is outside India and travel expenses are reimbursed, that is fully taxable. Only for travel within India, if any expenses are reimbursed by employer, then that we call as leave travel concession benefit, and that benefit is not taxable. That exemption is available only for 2 journeys in a period of 4 years. That means what LTC exemption is not available every time. LTC exemption is available only for 2 journeys in a period of 4 calendar years. So here important thing is not financial year, calendar year. 1986 is the first calendar year. From that time onwards, LTC benefit was allowed as exemption. So from 1986 onwards, for every 4 calendar years, 2 times LTC benefit is allowed as exemption. The current block is 2020 to 2025. So from 2022 to 2025, what you need to take is calendar year, not financial year. In this period of 4 calendar years, how many times? 2 times LTC exemption can be claimed. So maximum LTC exemption allowed is for only 2 times in a block of 4 calendar years. Another important thing is LTC exemption is available only if SSE is paying taxes under optional tax rates. If SSE is paying taxes under default tax rates, LTC exemption is not available. Another important point. Whatever the actual traveling expenses are there, actual traveling expenses are not allowed as exemption, because let's say employee want to go to Delhi from Vijayawada on in a flight. Employee can go in many ways. He can go from Vijayawada to Hyderabad, Hyderabad to Mumbai, Mumbai to Chennai, Chennai to Kolkata, Kolkata to Madhya Pradesh, Madhya Pradesh to Delhi. Okay, he loves flight journeys. He traveled just to go to Delhi. He traveled like this. He traveled 7 to 8 flights, and all travel expenses are reimbursed by employer. In this case, whatever the flight cost is there from Vijayawada to Delhi, only that flight cost amount is allowed as exemption. So for shortest route, whatever the flight expenses are there, economy class fare expenses are there, only that amount is allowed as exemption. So actual travel expenses are not allowed as exemption. For the shortest route, whatever the charges are there, economy class charges, that is only allowed as exemption. If journey is performed by way of rail, for the shortest route, whatever the first class AC ticket price is there, only that amount is allowed as exemption. If journey is performed by public transport, for example, road transport, then for first class and deluxe class bus, whatever the ticket price is there for the shortest route, that price amount is only allowed as exemption. If journey is performed in the form of ship, if there is no public transportation exists, in such a case, whatever the area is there, let's say from Chennai to Andaman, travel happened through ship. From Chennai to Andaman, whatever the area is there, whatever the distance is there, aerial distance, for that aerial distance, whatever the first class AC railway ticket price is there, that amount is allowed as exemption. So please don't think that actual travel expenses are allowed as exemption. No. For the shortest route, whatever the price is there, only that amount is allowed as exemption. Another important thing, what I said, in a block of 4 calendar years, only 2 times LTC exemption is allowed. Correct? What is previous block? Previous block is 2021, 2020, 2019, 2018. In this block also, 2 times LTC exemption can be is allowed, right? But leave travel concession is not claimed by employee. Whenever LTC exemption is not claimed, 2 LTCs are available, right? One will lapse, and second LTC, second leave travel concession exemption can be carry forwarded to next block. Next block is what? Next block is 2022, 2023, 2024, 2025. That means in this next block, total 3. Whatever the carry forward is there, that 1 LTC exemption and 2 LTC exemptions which are ordinary allowed. total 3 LTC exemptions can be availed. That means in any particular block of 4 calendar years, if LTC exemption is not availed, or if only one LTC exemption is availed, then whatever the balance one LTC exemption is there, that can be carried forwarded to next block. In next block, in total 3 LTC exemptions can be availed by employee. So for this purpose, family means spouse, children, parents, dependent brothers and sisters. Another important point. On or after 1st October 1998, LTC exemption is available only for 2 children. Employee is having 3 children. For 3 children, LTC exemption is not available. Out of 3 children, only for 2 children, LTC exemption is available. So, if the date of birth of children is on or after 1st October 1998, okay, 1st October 98. Before 1st October 98, how many children are there? For all children, LTC exemption is available. But on or after 1st October 1998, only for 2 children, LTC exemption is available. Now, many students will get doubt. Sir, first birth, single child, second birth, multiple children. Now, second birth is not in the hands of the individual, right? So, in this case, for all the children, LTC exemption is available. Are you able to understand? So generally, on or after 1st October 98, only for 2 children, LTC exemption is available. But if second birth or multiple children, twins or triplets, in such a case, LTC exemption is available for all the children. Let us see one problem so we'll understand better. Mr. D went on a holiday on 25th December 24 to Delhi with his wife and 3 children. One son age 5 years, twin daughters age 3 years. Age 5 years means what? First birth is single child. Correct? Second birth are twins. Now this is not in the hands of employee, right? So for all the 3 children. So first birth person, child and second birth twins. For all the 3 children, LTC exemption is available. They went by flight economy class and the total cost of tickets reimbursed by his employer are 60,000, 45,000 for adults and 15,000 for 3 minor children. So you can see exemption for all his 3 children are available. So he can claim. Why he can claim? Because generally on or after 1st October 98, only for 2 children exemption is available. But in this case, second birth are multiple children. That is not in the hands of the person. So that's why for multiple children and first single child, LTC exemption is available. In the above question, will there be any difference if among his 3 children, twins were 5 years old and son are 3 years old? Twins 5 years means what? They are born earlier. So first birth, 2 children. So 2 children are already covered. Second birth, single child. Now in this case, what is the rule? On or after 1st October 98, LTC benefit is available only for 2 children, right? So only for these 2 children exemption is available. For the single children exemption is not available. So for children in total how much? 15,000, right? Flight ticket divided by 3. That means for each children 5,000 rupees. So 2 children, right? 2 into 5,000. 10,000 is allowed as exemption and for 1 children 5,000 is not, exemption is not available and 5,000 will be taxed. Is it clear? See, there are 4 types of provident funds: recognized provident fund, unrecognized provident fund, statutory provident fund, public provident fund. In recognized provident fund, it means what? It is the provident fund which is approved by Commissioner of Income Tax, that we call as recognized provident fund. Those provident funds which are not approved by Commissioner of Income Tax are there, those we call as unrecognized provident funds. Statutory provident funds means what? In case of statutory provident fund, like it is only for government employees. So it applies to employees of government, railways, semi-government institutions, local bodies, universities, and all recognized educational institutions. So these set of employees, uh, for these employees, whatever the provident fund is there, that provident fund we call as statutory provident fund. Public provident fund means what? Both salaried employees and self-employees can deposit money in public provident fund. That means what? Like I'm engaged in profession or businessman is there. Okay, for them, provident fund concept will not be there by employer. Employer, there is no employer for business people and professional people. So even those persons also, if they want to deposit money in provident fund, they can deposit in public provident fund. Are you able to understand? So four types of provident funds are there. Now, employer, he will contribute to provident fund of employee, PF account of employee. So every month to PF account of employee, employer will contribute. Employee will also contribute, right? There will be employer contribution and there will also be employee contribution. On employer contribution, there will be interest, right? Let's say employer contributed 1 lakh rupees. On that 1 lakh rupees, Provident Fund organization will pay interest. So there will be interest on employer contribution and there will be interest on employee contribution. So likewise, Provident Fund amount gets accumulated on a monthly basis. Every month there will be employer contribution, there will also be employee contribution, and there will be interest on employer contribution and interest on employee contribution. So prima facie, four questions are there. First question is taxability of employer contribution. How employer contribution is taxable? Second question is taxability of employee contribution. Third question is taxability of interest. On employer contribution and employee contribution, there will be interest, right? The third question is taxability of interest. Fourth question is after some time, employee will withdraw money from Provident Fund, right? At the time of withdrawal, what is the taxability? So taxability at the time of withdrawal. So in total, four questions are there. Taxability of employer contribution, taxability of employee contribution, taxability of interest, taxability at the time of withdrawal. Four questions are there. Four provident funds are there. Recognized provident fund, unrecognized provident fund, statutory provident fund, public provident fund. So in total, 4 into 4, 16 questions are there. 16 questions are given in the form of a matrix over there. Are you able to understand? So recognized provident fund, unrecognized provident fund, statutory provident fund, public provident fund, four provident funds, four different questions. So in total 16 questions are answered through this matrix. Listen, employer contribution to recognized provident fund. If employer contributes up to 12% of salary, then employer contribution is not taxable, it is exempt. If employer contributes more than 12%, whatever the excess contribution over and about 12% is there, that is taxable. Let's say employer contributed 15% of salary to recognized provident fund, up to 12% exempt, extra 3% is taxable. Are you able to understand? Salary for this purpose is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. So on a monthly basis, employer contribution up to 12%, up to employer contribution to recognized provident fund up to 12% exempt. In excess of 12%, it is taxable. Employer contribution to unrecognized provident fund, it is not taxable on a monthly basis. At the time of withdrawal, it is taxable. Are you able to understand? Employer contribution to statutory provident fund. I told statutory provident fund, government employees, okay, railway employees, education institution employees, university employees. So if employer contributes to statutory provident fund, such employer contribution is also not taxable, it is fully exempt. There is no concept of employer contribution to public provident fund, so not applicable, because in case of public provident fund, individual himself has to deposit, okay, employer will not contribute. So there is no concept of employer contribution to public provident fund.
Next, employee contribution. See, I am working in Infosys. My own money I am depositing in Provident Fund account. If my own money, if I am depositing it, will it be taxable? It is not taxable. I am getting salary. Salary already taxed. That salary amount I am depositing in employees Provident Fund account. Again, will it get taxed? It is not taxed. So whatever the employee contribution to recognized provident fund is there, that is not taxable. But whatever my contribution, employee contribution to provident fund is there, that amount is eligible for deduction under section 80C only if SSC is paying taxes under optional tax. Next, employee contribution to unrecognized provident fund. It is not eligible for deduction under section 80C. 80C deduction is not available. So 80C deduction is available only if employee contributes to recognized provident fund. Employee contribution to statutory provident fund, that is also eligible for deduction under section 80C only if employee is paying taxes under optional tax rates. Even if individual contributes amount to public provident fund, that is also eligible for deduction under section 80C. So very simple. Employees contributions or individual contribution to recognized provident fund, statutory provident fund or public provident fund, that is eligible for deduction under section 80C. Next, interest will be received on employer and employee contribution, right? If rate of interest received is up to 9.5% per annum, it is exempt. If rate of interest is in excess of 9.5% per annum, it is taxable in case of recognized provident fund. In case of unrecognized provident fund, it is not taxable on a monthly basis. It is taxable ultimately at the time of withdrawal. And interest credited for statutory provident fund fully exempt. See, statutory provident fund, government employees on a monthly basis, employee contribution not taxable. Not only employer contribution, if there is any interest on employer and employee contribution, that is also not taxable, fully exempt. That's why everyone will crave for government job. Next, interest related to public provident fund, that is also fully exempt. Now, withdrawal, amount received on retirement, etc. Withdrawal. First, I will explain for unrecognized provident fund. Withdrawal from unrecognized provident fund. See, there are four components, right? From unrecognized provident fund, ultimately at the time of withdrawal, if employer contribution is withdrawn, at the time of withdrawal, employer contribution is taxable under the head salaries. If an interest on employer contribution is withdrawn, then also it is taxable under the head salaries. Employee contribution withdrawn, whatever the employee contribution that is withdrawn is there, that is not taxable. Sir, why is it not taxable? One simple logic I will tell. I will deposit 20,000 rupees in my savings bank account. After 2 years, I will withdraw 20,000 rupees. Will it be taxed? It will not be taxed because my own money I have withdrawn. Same concept. Employee contribution, his own personal money he deposited in Provident Fund. After some time he is withdrawing that money. Will it be taxed? It will not be taxed. On the amount deposited, if any interest is generated, that is income, right? So that's why interest on employee contribution is taxable under income from other source. Interest on employee contribution taxable under. So at the time of withdrawal, employer contribution withdrawn, interest on employer contribution withdrawn, taxable under salaries. Employee contribution withdrawn, not taxable. Interest on employee contribution withdrawn, taxable under other sources. Next. See, if amount is withdrawn from statutory provident fund and public provident fund at the time of withdrawal, it is not taxable, it is fully exempt. Next, from recognized provident fund, you can see here, if amount is withdrawn from recognized provident fund, accumulated balance of recognized provident fund, very important. Amount withdrawn from recognized provident fund. If employee withdraws amount from recognized provident fund after completion of 5 years of service, that means after completing 5 years, amount withdrawn from recognized provident fund, not taxable, exempt. Before completion of 5 years, amount withdrawn by employee from recognized provident fund. What is the question here? whether employee finished 5 years. No, employee did not finish 5 years. Even before 5 years only, employee withdrawn amount from recognized provident fund. Then we have to check the reason why employee withdrawn before 5 years. If employee withdraws before 5 years because of his ill health or closure of business by employer. Employer closed the business, employee became unemployed. That's why he withdrawn the money. Valid reason. Ill health of the employee. He could not do the job. Withdrawn money. Valid reason. Any other cause beyond the control of the employee. So for these three reasons, if amount is withdrawn before 5 years, what are those three reasons? Ill health, closure of business by employer, reason beyond the control of employee. For these three reasons, if amount is withdrawn before completion of 5 years, then also benefit is not taxable. If the reason is any one of these three reasons, if it is S, then exempt. Otherwise, if it is any other reason, next. That means what? Employee withdrawing money from recognized provident fund. Did he continue for 5 years? He did not continue for 5 years. Or the reason for withdrawal is ill health or closure of business or reason beyond control of employee? No, that is not the reason. Then we have to check. The reason can be employee worked in an organization for 3 years and he left the organization. After leaving the organization, he joined the new organization. If he transfers his provident fund account from old organization to new organization, then count will continue. He worked in previous organization for 3 years and joined in new organization. He shifted provident fund account. Once he shifts provident fund account, this 3 years term will also continue. So is the entire recognized provident fund balance transferred to his recognized provident fund account maintained by new employee. So if whatever the RPF balance is there, if it is transferred from old employer to new employer, then the transfer is not taxable, it is exempt. If we did not transfer, then you have to then in case it becomes taxable. How it is taxed? Just like how unrecognized provident fund is there, in the same way it is taxable. Another point is also there. Employee did not complete 5 years. Still he is withdrawing amount from recognized provident fund. The reason for withdrawal is not ill health, not closure of business by employer, not any reason beyond the control of employee, but he is transferring recognized provident fund account to NPS account under section 80 CCD. So RPF amount is transferred to NPS account. If RPF amount is transferred to NPS account before 5 years, then also it is exempt. If it is no, then it is taxable. Very simple. 5 years after amount withdrawn, exempt. Before 5 years withdrawn, three reasons, exempt. Before 5 years withdrawn, reason is not the three reasons. Then other reasons are there. What are those other reasons? Transfer of amount to new employer or transfer of amount to pension scheme, NPS. Then also it is exempt. Other than these two reasons, it is taxable. Amount withdrawn from recognized provident fund. How it is taxable? Employer contribution, interest on employer contribution, taxable as salary. Employee contribution, not taxable. Interest on employee contribution, taxable under other. Did you understand? See, there are 4 types of allowances. Some of the allowances are fully taxable allowances. These allowances are fully taxable under default tax regime as well as under optional tax regime. Entertainment allowance other than government employees. Why other than government employees? If entertainment allowance is received by government employees, they can claim deduction under section 16(2). So other than government employees, if they receive any entertainment allowance, that entertainment allowance is fully taxable both under default tax rates as well as under optional tax rates. You know DA, right? Dearness allowance is also fully taxable. Overtime allowance for doing extra work, if any allowance is received, that is also fully taxable. Medical allowance we have discussed. If lump sum amount is given for medical expenses, medical allowance, that is also fully taxable. City compensatory allowance. Whenever employee shifts from one place to another place, non-metro to metro, their cost of living is higher. So to compensate cost of living, if any extra allowance is given, that allowance we call as city compensatory allowance, interim allowance, servant allowance, project allowance, food allowance, tiffin, lunch or dinner allowance, warden allowance. All these allowances are fully taxable. Transport allowance to employee other than physically handicapped employee. See, for physically handicapped employees, if they receive any transport allowance, from that they can claim exemption up to 3,200 rupees per month. So other than physically handicapped employees, if they receive any transport allowance, such a transport allowance is taxable, fully taxable. And any other cash allowance. So all these allowances are fully taxable. Some of the allowances are exempt up to the amount spent for official purpose. I have received amount. Out of this amount, how much of the amount is spent for official purposes is there? To that extent, amount is exempt, balance is taxable. Let us see now. Uh, First, let us see uniform allowance. Uniform allowance 10,000 rupees received. Out of 10,000, 6,000 rupees for purchasing and stitching the uniform. Now, up to 6,000 rupees it is spent for official purpose. So, up to 6,000 exempt, balance 4,000 it is taxable. So, helper allowance, research allowance. So, uniform allowance, helper allowance, research allowance. Out of these allowances, how much ever the amount spent for official purposes is there, to that extent it is exempt, balance it is taxable. Another thing is exemption is available only under optional tax regime. That means under default tax regime, uniform allowance, helper allowance, research allowance is fully taxable. Are you able to understand? Next, conveyance allowance, daily allowance, traveling allowance. Conveyance, right, to come to the office on any motorcycle or anything, any means of transport. If any conveyance allowance is given, out of that conveyance allowance, how much amount is spent for official purposes is there, to that extent it is exempt. Daily allowance, employee went on tour, there he needs to eat food, meet daily expenses. To meet daily expenses, if any daily allowance is given, out of the daily allowance, how much ever the amount is spent for official purposes is there, to that extent it is exempt, balance it is taxable. Traveling allowance also. Traveling expense allowance can be given at the time of transfer of employee, or with regard to general official trips also. Traveling allowance can also be given. So out of traveling allowance, whatever the amount spent for official purposes is there, to that extent it is exempt, and that exemption is available under both tax regimes, both default tax regime as well as under optional tax regime. Some of the allowances are fully exempt. Which allowances are fully exempt? If any allowance is given to Supreme Court or High Court judge. So for Supreme Court judge and High Court judge, if any allowance is given, such allowance is fully taxable. Sorry, such allowance is fully exempt only under optional tax rates. If they are paying tax under default tax rates, allowance to Supreme Court judge or High Court judge is fully taxable. Salary and allowance paid by United Nations organization to its employees. UNO paid salary to employees, and that salary is received by Indians or residents in India. That salary is fully taxable, right, generally. But if salary is received from UNO, even though it is Indian income, it is not taxable, it is fully exempt. Not only salary, if any pension is received from UNO, even that pension amount is also not taxable, even the pension amount is also fully exempt. Next, sumptuary allowance. Sumptuary allowance means, see here I have given sumptuary allowance is expenditure allowance that helps government officials to pay for official entertainment and hospitality. See, Supreme Court judge is there. Many people will come to meet him, Prime Minister, President, like this. Whenever these people come, he has to give bouquet, he has to take care of food expenses and all. So to meet official expenses, if any lump sum allowance is given to High Court judges or Supreme Court judges to meet hospitality expenditure, that allowance we call as sumptuary allowance. So sumptuary allowance given to High Court judge or Supreme Court judge is not taxable, it is fully exempt, only under optional tax rates. If Supreme Court judge or High Court judge is paying tax under default tax rates, then sumptuary allowance is fully. See, there are three conditions. First condition is individual should be Indian citizen, he should be a government employee, he should be working outside India. if these three conditions are satisfied, generally Indian foreign service people are there. They will work in visa offices outside India. They will work in Indian visa offices outside India. Now they all are Indian citizens. They are Indian government employees. Where they are working outside India. If all these three conditions are satisfied, even though they are receiving salary outside India, still their salary will be considered as received in India. Are you able to understand? Normally, under salaries, the place where service is performed, in that place salary is said to be accrued. Employee working in India, salary is accrued in India. Employee working in Pakistan, salary is accrued in Pakistan. Employee working in Australia, salary is accrued in Australia. So the place where services are provided, in that place only salary gets accrued. But if these three conditions are satisfied, individual should be Indian citizen, government employee, working outside India. If these three conditions are satisfied, even though government employee is working outside India, still his salary will be considered as salary will be deemed as accrued in India. So for those government employees, whatever the salary is there, that will be considered as accrued in India and it is taxable. The thing is, only salary is taxable if any allowances or perquisites received by those government employees, those allowances and perquisites are not taxable. They are completely exempt, and that exemption is available under both the tax rates. Next, some of the allowances are exempt up to the amount specified in the act. That means what? In act already certain amount is specified. To that extent only that allowance is exempt, balance it is taxable. For example, education allowance is there. Employee receiving 500 rupees education allowance. Now out of 500 rupees, 100 rupees is exempt for each children up to a maximum of 2 children. So this 100 rupees is already specified in the act. So whatever the amount that is already specified in the act, to that extent exemption is available and balance it is taxable. Are you able to understand? So, like many are there, out of these, there are some allowances are very important. Children education allowance, hostel allowance, mm, transport allowance, next HRA allowance. So, as amounts are given, these allowances you can read, but important ones I am going to explain. This one also. Allowances given to transport system. Children education allowance. If any children education allowance is received, out of that allowance, exemption is available for 100 rupees per month for each children up to a maximum of 2 children. Employee having 4 children, out of 4 children, only for 2 children, employee can claim exemption. Hostel allowance is there. That means children hostel allowance. Employee children if they are studying in hostel, and for that purpose if any hostel allowance is received from employer, out of hostel allowance that is received, 300 rupees per month is exempted up to a maximum of 2 children. Next, transport allowance given to those employees who are physically handicapped. So if generally if transport allowance is given, that is fully taxable. But if transport allowance is given to physically handicapped employees, then physically handicapped employees can claim exemption of 3,200 rupees per month under both the tax rates. Are you able to understand? Transport allowance exemption of 3,200 for physically handicapped employees is available both under default tax rates as well as under optional tax rates. See, allowance granted to employee working in a transport system, that means transport company employees. This in shortcut called as running allowance. So if any running allowance is given to transport company employees, lorry driver is there, okay, he is an employee of transport company. If he receives any running allowance, why running allowance is given? He goes from Vijayawada to Chennai, Vijayawada to Delhi, Vijayawada to Nagpur, okay, he has to, like Vijayawada to Delhi he will go for 9 to 10 days because he goes very slowly at 40 kilometers per hour. Meanwhile, he has to stop at certain places and he has to eat food, he will have personal expenses. So during travel, to meet his personal expenses, running allowance will be given. Out of total running allowance that is received, 70% of the allowance or 10,000 per month, whichever is lower, is allowed as exemption. Are you able to understand? So running allowance received by transport company employee, out of total running allowance received, how much is exempt? 70% of the allowance or 10,000 per month, whichever is lower. Please remember 1 to 13 till here, whatever the allowances are there, for these allowances, exemption is available only under optional tax rates. For 14th one, exemption is available both under default tax rates as well as under optional tax rates. House rent allowance, very important. Quite often it is being asked in the examination. So listen very carefully. I have also explained one problem for your better understanding. Generally, to compensate house rent, allowance is given by the employer. That allowance we call as house rent allowance. If any house rent allowance is received, it is not fully taxable. From that, exemption is allowed. If employee is living in Delhi, Mumbai, Kolkata, Chennai, then separate calculation is there. If employee is living in other cities, then separate calculation is there. If employee is living in Mumbai, Delhi, Kolkata, Chennai, then actual HRA received or rent paid minus 10% of the salary or 50% of the salary, whichever is lower, will be allowed as exemption. Exemption is allowed in 3 steps. When if employee is living in Mumbai, Delhi, Kolkata, Chennai, what are 3 steps? Actual HRA received, rent paid minus 10% of salary or 50% of the salary. Out of these 3, whichever is lower is allowed as exemption. If employee is living in other cities, then actual HRA received, rent paid minus 10% of salary or 40% of the salary, whichever is lower. That means the change is 40% for other cities and 50% for Delhi, Mumbai, Kolkata. And for this purpose, we are using salary, right? Salary definition is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. Employee living in his own house and is receiving HRA, fully taxable. Only if employee pays rent, then only HRA exemption is available. If employee do not pay rent, HRA exemption is not available. Next, HRA allowance is given for only 4 months. You have to take only 4 months salary, and on that 4 months salary you have to apply 10%. Are you able to understand? So relevant period means only for the period for which HRA allowance is given. Question. Mr. Rajkumar has the following receipts from his employer. Basic pay 40k per month, dearness allowance 6k per month, commission 50,000 per annum, motor car for personal use, expenses met by employer 1500 per month, house rent allowance received 15,000 per month. Find out amount of HRA exempt in the hands of Mr. Rajkumar, assuming that he paid a rent of 16,000 per month. So how much is the rent that he paid? 16,000 per month. Important point, HRA benefit is available only if SSE is paying taxes under optional tax rates. If SSE is paying taxes under default tax rates, HRA exemption is not available. Okay. Now, shall we calculate what is the formula? First, how much is HRA received? HRA received is 15,000 per month, right? So 15,000 into 12 months, how much? 1,80,000. Exemption is allowed in how many steps? Exemption is allowed in 3 steps. Step 1, actual HRA received. How much is actual HRA received? 1.8 lakh. Step 2, rent paid minus 10% of salary. How much is the rent that is paid by him? 16,000, right? So 16,000 into 12 months minus 10% of salary. So salary for this purpose is basic, DA, commission as a percentage of turnover. See, commission as a percentage of turnover is to be considered. This is general commission. General commission should not be considered. Okay. So basic 40, dearness allowance 6,000. So 46,000 into 12 months into 10%. How much? 16,000 into 12, 1,92,000 minus 46,000 into 12 months into 10%. How much? 55,200. 1,36,800. Step 2 is 1,36,800. Step 3, 50% of salary. Wait. Where is he living? Kanpur. He is living in Kanpur. So Kanpur means other than Delhi, Mumbai, Kolkata, Chennai. You have to consider only 40% of salary. So 46,000 into 12 months into 40%. 2,20,800. Whichever is lower means 1,36,800 is allowed as exemption. How much is taxable? 43,200 is tax. Now did you understand? 43,000. So that's all about HRA. Now let us discuss deductions under section 16. First 16(1)(a) standard deduction. See, there is amendment. Under default tax rates, standard deduction is allowed up to 75,000 rupees. Please remember, earlier 50,000 under both tax regimes. Now, under default tax regime, standard deduction was increased from 50,000 to 75,000. Under optional tax rates, standard deduction is 50,000. Under default tax rates, standard deduction is 75,000. Please remember. And in examination, once you finish calculation of salary, you please claim standard deduction. Many students forget to claim standard deduction. You should claim standard deduction. Okay. For default tax rates, you should claim 75,000. For optional tax rates, you should claim 50,000. Section 16(2). See, section 16 to 16(3). These deductions are available only under optional tax rates. 16(1) standard deduction is available under both tax regimes, but 16 to 16(3) is available only under optional tax rate. 16(2) entertainment allowance. Deduction for entertainment allowance under section 16(2) is allowed only for government employees. That means only government employees can claim deduction under section 16(2). See, whatever the entertainment allowance that is received by government employee is there, first that is included in gross salary, later on deduction is allowed. How much deduction is allowed? 5,000 rupees or 1/5 of basic salary or actual entertainment allowance received, whichever is lower. Are you able to understand? Actual entertainment allowance 5,000 rupees, 1/5 of the basic salary. Out of these three, whichever is lower is there, that is allowed as deduction. Section 16(3), profession tax. Even profession tax is also allowed as deduction only under optional tax rate. See, I am getting 1 lakh rupees salary. Out of 1 lakh rupees salary, Infosys deducted 200 rupees profession tax. Infosys paid only 99,800 to me. Now, in my calculation, in gross salary, I will show 1 lakh rupees. Under section 16(3), I will claim deduction of 200. So thereby my net salary will be 99,800. Are you able to understand? So whenever employer deducts the professional tax and employer pays profession tax to the government, consider total salary in calculation of gross salary. From that, whatever the profession tax that is deducted is there, claim as deduction under section 16(3), and net salary will be gross salary minus profession tax. Infosys paid total 1 lakh rupees to me. I myself paid 200 rupees profession tax to the government. In this case, gross salary will be 1 lakh rupees, profession tax 200 rupees is allowed as deduction under section 16(3), and 99,800 is taxable. Please understand, whether profession tax is paid by employer or paid by employee, it is allowed as deduction under section 16(3). But if profession tax is paid by employer, that is considered in gross salary. See, here actually my received salary is 99,800. In hand, I received only 99,800. Even though I received 99,800, additional 200 is also taxable. Additional 200 is also taxable. Why additional 200 is also taxable? When calculating gross salary, whatever the profession tax paid by employer is there, that is also included in gross salary, and later on deduction is allowed under section 16(3). Are you able to understand? So if profession tax is paid by employer, first include in gross salary, then eligible for deduction. Is it clear? Next, tax treatment for profession tax paid by employee. If employee is paying profession tax, don't include in gross salary, straight away claim deduction under section 16(3), 200 rupees. Are you able to understand? Profession tax paid by employer, first include in gross salary, later on deduction allowed under section 16. Profession tax paid by employee, don't include in gross salary, claim deduction under section 16. Is it clear? Next, profits in lieu of salary. See, at the time of termination of employment or at the time of modification of terms and conditions. For example, I am appointed as CEO for whole India. Later on, for 5 years, I am appointed as CEO for 5 years. After 3 years, I was reappointed as CEO only for South India. Earlier, my scope is for whole India, but now my scope was reduced to South India. There was change in terms and conditions, right? Initial agreement was for 5 years. Before completion of 5 years, in third year, there is change in terms and conditions. My scope was reduced to South India. As there is change in terms and conditions, lump sum compensation is paid to me, 5 lakh rupees. Whatever the amount that is received for termination of employment or for modification of terms and conditions, whatever the lump sum amount that is received is there, that is considered as profits in lieu of salary, and it is also taxable under the head income from salary. And any payment received under keyman insurance policy. So under keyman insurance policy, if employee receives any amount, that amount is taxable to the employee under the head income from salaries, and it is considered as profit in lieu of salary under section 17(3), and it is taxable. Next, see, when we are discussing Provident Fund, welfare contributions, from recognized Provident Fund, if employer contribution is withdrawn and interest on employer contribution is withdrawn, that is taxable under the head salaries, right? Employer contribution withdrawn, interest on employer contribution, that is taxable under the head salaries. Even this is also considered as profit in lieu of salary. Are you able to understand? So employer contribution, interest on employer contribution withdrawn from recognized Provident Fund is also considered as profit in lieu of salary, and it is taxable under the head salaries only. Before joining employment, after cessation of employment, if you remember at the beginning of salaries, I told you, even before joining the employment, from future employer, if any benefit is received, that is taxable under the head salaries, that is considered as profit in lieu of salary. So before joining the employment or after coming out of the employment, if any lump sum amount is received from employer, that lump sum amount we call as profit in lieu of salary, and it is also taxable under the head. As you have listened to class till now very patiently, I have one benefit for you. Many students are asking me, sir, there are many salary definitions. For rent-free accommodation, one salary definition is there. For leave encashment, one salary definition is there. For Provident Fund, one salary definition is there. So many salary definitions are there, sir. We are getting confused. So for all of you, I have simplified salary definition. Okay, there are only 3 salary definitions. 1, 2, and 3. For rent-free accommodation, separate salary definition is there. For non-government employee covered under Payment of Gratuity Act. Do you remember retirement benefits? Gratuity exemption. If employee is covered under Payment of Gratuity Act. And for retrenchment compensation, salary definition is basic plus DA forms part of retirement benefits plus commission as a percentage of turnover. Employee not covered under Payment of Gratuity Act, leave encashment, HRA exemption, recognized Provident Fund, VRS compensation. For these categories, salary definition is basic plus DA forming part of retirement benefits plus commission as a percentage of turnover. For these two, salary definition is basic plus any DA. Any DA means DA forming part plus DA not forming. So I have summarized. Please go through this chart before going to the examination. It will be of very much use to you. Okay, so you will remember all the salary definitions, and in the examination you will not commit mistake. And see, we are also seeing government employee at multiple places. So I have simplified government employee definition also. For rent-free accommodation, leave encashment, entertainment allowance, government employee means central government employee or state government employee. For gratuity, government employee means central government employee, state government employee, local authority employees, IPS, IAS officers, civil service employees, and defense service employees. For commuted pension, even statutory corporation employees are also considered as government employees. So the summary of government employees definition and the summary of salary definition is given. Oh, it took a lot of time to classify all these, but anyhow, it will be of very much use to you. So I wish you all the very best. If you find this content very much useful, please share with your friends also. So whatever the expenditure that I have spent to provide you with free classes, that will be meaningful. Okay, thank you.